Move to attract foreign investments, capital gains tax scrapped for FPIs investing in government bonds. FIIs will now enjoy zero tax on both interest and capital gains from G6. Rupee makes a sharp comeback, easing all its losses for the week after the RBI unveiled fresh measures to attract foreign capital. Rupee sees best performance in 2 months. RBI keeps repo rate unchanged at 5.25% amid the oil price shock. RBI opts for caution as inflation outlook rises. Market ends above 23,000 mark, slightly changed after a volatile session as investors digest a slew of measures by the government as well as the RBI governor's remarks on policy. Nifty and Sensex shed 0.7% for the week. Crude eases slightly amid uncertainty and prices steady since yesterday. Trump signals optimism on talks. Brent holds around $94 a barrel, while Israel strikes persist in Lebanon despite ceasefire tensions simmering. Ukraine President Zelensky writes an open letter to Putin for a face-to-face meeting in a renewed bid to end the war, but Kremlin denies seeing the letter yet. The Annamalai BJP breakup is official. Party Saftar quitting. Also BJP and Annamalai eyes new party for 2031 polls. BJP says no loss for the party. VinFast-backed Green SM enters India with all-electric taxi services. Launched in Delhi NCR, betting big on EV mobility as a ride-hailing battle heats up in key urban markets established by Ola and Uber. Hello and welcome. You've tuned into Profit 360. I'm Nisha Podar, and big breaking story at this point. From the macroeconomic perspective, India sees FY26 GDP growth at 7.7%. Estimate was of 7.5%. India's Jan-March GDP rises 7.8%. Estimate was 7.3%. And India's Jan-March GVA rises 7.9%. Estimate of 7.3%. Now remember that Jan's and March farm growth is 3.6% growth. Mining growth of 5.4%. And remember, the manufacturing growth comes in at 7.1%. Power, gas account for 4.1%. All right, so those are the numbers really flashing. Estimate of 7.5%, and the actual is at 7.7%. All right, let's take it straight to an economist. Mithali Nikore, founder of Nikore Associates, joins in. Mithali, your first take on the estimates being beaten when it comes to GDP growth.
No, absolutely, Nisha. I think this is really something which we should be really happy about. We should celebrate this, especially given the tough headwinds that we're actually going to be facing in the Q1 of FY26. A strong Q4 of FY25 is what we really needed today. And, what we have seen is that this is really growth which has been driven by a number of, sectors. Consumption, of course, remains one of the key, foundations of this growth. But also we see that agriculture coming in at a stronger number, 3.6 was projected. Now we're seeing a 3.8 and actual coming in over there. Mining really coming in as one of the most important contributors to this growth. And then also the services sector, bucking its trend and also showing very strong numbers. So I think it just shows that the first quarter of the country, of the economy, is really a barometer for India's structural prowess and the structural strength of the Indian economy, which of course has, been taking the onslaught of the West Asia crisis. But it shows us that our basic fundamentals remain extremely strong.
Right. So while Mithali, we are exuberant about beating the estimates, but let's look at all the parameters. While FY26 GDP growth is at 7.7%, estimates of 7.5%, Jan to March GDP at 7.8% versus 7.3% estimate. While consumption, mining are the big boosters coming in, but it was also only 1 month of the war-related pressure. And that too, the pressure would have trickled into the economy and not onto the data as much. How do you assess that, and also an outlook on what could really come when it comes to GDP in the first quarter of FY27 then?
So I think the first quarter of FY27 is the one whose numbers are the ones that are making a lot of analysts, a lot of economists. I wouldn't say nervous, but we are, disappointed at the fact that the global economy, I wouldn't even say the Indian economy, right? The entire global economy was doing so well. We were seeing record low unemployment in the United States, for example. We were seeing that, in countries like Bangladesh, there was recovery taking place. In several African economies, were posting positive rates of GDP growth. Gulf countries were at an all-time high in terms of foreign investment. So, the overall exuberance in the global economy has been tampered and has been tamed because of this oil price shock. And I do expect that, in this quarter, what we've seen, this strong growth can tide us through for at least 3 more quarters, that is the entirety of 2026 calendar year. And you look at the manufacturing growth, right? The numbers that are coming in, and 11% growth in manufacturing in this quarter, that is absolutely unprecedented, because you look at the previous 6 or 7 quarters and we haven't seen that kind of growth in India, again showing that semiconductors, electronics, some of these new age industries are the ones that have carried India forward.
That's right. In fact, Mithali, it pains to see this kind of a number now, because we know that a large part of that could be really facing some challenges in this first quarter of FY27. So the world has changed. If we could have carried that particular momentum that we are showcasing now in numbers, it would have been a great deal for this whole momentum of even this financial year, as you correctly said. All right. Thank you so much, Mithali, for joining in with your expert take on the GDP numbers and what it really shows about the economy. Moving on, another important top story of the day: India is making a strong pitch for global debt flows by scrapping the taxes on foreign investors' government bond investments. And the center is really aiming to make Indian G-Secs more competitive in the world market, attractive and also, remember, liquid in global portfolios. Meanwhile, the government has also opened the doors wider for the foreign investors, easing the investment limits and expanding the access routes. Let's listen into what RBI's Governor Sanjay Malhotra had to say on this.
We are expanding the universe of specified securities by including all new issuances of 15, 30, and 40-year tenor G-Secs. Till now, only securities, government securities up to 10-year tenor were included. In addition, limits pertaining to short-term investment, concentration, and individual securities on FPI investment under the general route are being removed. The government recently, this morning, has provided tax benefits to government securities. All these measures together should help attract foreign capital for government borrowing.
Right, help attract foreign capital, especially in the bond market. So in a sweeping set of tax changes, FIIs will now enjoy zero tax on both interest as well as capital gains from G-Secs. Let's take it across to Shrimi for a detailed breakdown of what this really means for the flows, yields, as well as the rupee movement. Shrimi, tell us.
Of course, the headline move is a full tax exemption for FPIs on the interest income and capital gains from the government securities effective April 1st, 2026. This means that the foreign investors will no longer pay the 12.5 LTCG tax on GSEC, while 20% withholding tax on interest income will also be removed. Now, for the clarity and the benefit of our viewers, just for clarity, that exemption applies to any eligible interest income received or capital gains earned on or after April 1st, 2026, even if the ordinance issued later. A separate notification will ensure that no tax is deducted at source on such income. Now, this too clarity is very important to understand the overall benefit. Now, on the equity front, the government has eased FEMA rules for the persons resident outside India, PROIs. This investment limit for individual PROIs and listed companies has been doubled to 10% from existing 5%. While the aggregate limit for all individual has been raised to 24% from the 10% under the portfolio investment scheme. Now, in the bond market, the government has expanded the fully accessible route to include 15 years, 30 years, 40 years government securities along with the sovereign green bonds. Now, it has removed, several long-standing FPIs restrictions, including, short-term investment limits, your concentration limits, and overall security-wise caps, etc., on the government securities. But one thing we need to keep in mind that overall FPI's investment cap remains unchanged at 6% for central government and 2% for state government bonds. So taken together, of course, the measure represents one of the biggest liberalization step for the foreign investors in the recent year and are aimed at deepening the India's bond market.
That's right. Very well put, Shrimi. Thanks so much for all the details. Now, we also spoke to various industry experts on the government's decision to waive the 12.5% long-term capital gains tax on foreign investments in government bonds. In fact, Axis Bank's Neeraj Gambhir calls it a strong incentive that could attract long-term global inflows into India's 40-year bond market. And Dhruva Advisors Dinesh Kanabar says that the move makes it far easier for the investors to participate in Indian bonds. Listening.
So I feel that this is a good incentive for the investors to start investing in domestic market. India is one of those few markets where you have long-term bonds, where you have bonds going all the way up to 40 years. Not many economies of the size of India offer that kind of duration, which is very, very attractive to insurance companies. So I feel that you will see some real long-term flows coming in as a result of this.
The fact that there is zero compliance burden, because now I don't need to really file a tax return at all. There is no such thing. I don't need to meet a custodian. I don't need a chartered accountant in India. I need nobody to give me advice. I'm simply sanguine that the interest which I have got is my income, nothing further to be done. And I do wish that even as we look at many of the other things on equity, it's a different subject, of course, altogether, that we are able to provide better certainty and ease of compliance to investors as we are doing for government securities.
All right, so those were the experts talking about what this move can really mean. And the rupee, because of dollar inflows getting attractive, rupee obviously had a sentimental improvement also today on the very first day. Rupee has staged a sharp comeback, easing all its losses for the week after the RBI unveiled the fresh measures to attract foreign capital. Now, the currency strengthened nearly 0.8% today and this week and has slipped below the 95 per dollar mark for the first time since Monday, while easing pressure from the Middle East conflict and RBI support have really boosted the sentiment, and the bigger picture remains challenging. Now, the rupee is still down around 6% against the dollar so far in 2026 and remains nearly 5% weaker compared to the levels seen before the Middle East war erupted. Markets will now watch out whether the foreign inflows can really sustain this kind of a recovery in the Indian currency. All right, from the Reserve Bank of India, while this stole the show when it comes to the reforms to attract the foreign capital in the bond market, but the bigger news definitely is the monetary policy as well. And the RBI has kept the repo rate unchanged at 5.25%, choosing caution over a rate move as global uncertainties really continue to cloud the outlook. Now, Governor Sanjay Malhotra also flagged the risks from elevated crude prices, supply chain disruptions, and even geopolitical tensions, while the central bank also revised down its growth forecast and raised its inflation outlook. Listen in.
The Monetary Policy Committee met on the 3rd, 4th, and 5th of this month to deliberate and decide on the policy repo rate. After a detailed assessment of the evolving macroeconomic and financial developments and the outlook, the MPC voted unanimously to keep the policy repo rate under the LAF unchanged at 5.25%. Consequently, the STF rate remains at 5% and the MSF rate and the bank rate at 5.5%. The MPC also decided to continue with the neutral stance.
All right, so that was the RBI governor, and India's growth story may be stronger than official projections suggest. That's the view coming in from now the newly attained role that Neelkant Mishra has got. World Bank's executive director Neelkant Mishra says that RBI's growth estimates appears conservative, with internal assessment really indicating growth could really approach 8%. Listen in to his comments and his views.
On the growth side, I think RBI's forecasts are too conservative. I think the economy is doing far better than what they're building in. But that's the difference, I guess. When they have to be the official forecaster, they may be slightly more conservative. Our expectation, our assessment is that the economy was growing at almost 8% in the Feb-March period. Because of the oil prices going up and some headwinds, it has corrected, just slowed down a bit. Our current rate would be closer to 7% or maybe slightly below. But as the year progresses, and if the oil markets are right, and we say end the year at $80, we may be accelerating above 7%.
All right, and to find out what were the main constituents of the monetary policy today, here are the top takeaways from my colleague Piyush Shukla, right from the RBI's headquarters. Piyush.
The RBI's MPC has announced its final decision to keep the repo rate unchanged at 5.25%. Here are the top 5 key takeaways that we understand from this policy are important. First, the slew of measures that the RBI has announced to bring in more dollars, whether it be allowing FPIs to invest in 15-year, 30-year, 40-year G-Secs as against 10-year G-Sec only earlier, and bearing the hedging cost for banks to raise FCNR deposit of 3 to 5 year tenor. These measures are aimed at boosting foreign inflows. Although the governor said that he does not target any level or they do not estimate any particular amount that will come in, he said that the RBI expects healthy inflows to come in because of these measures. We are aware the government, in tandem working with the RBI, also said that it will remove the taxes for FPIs who are investing in G-Secs. Key takeaway number 2 is that with regard to the tone of RBI MPC, it has shifted. Now we can clearly see a hawkish sort of a tone by the governor. In his initial remarks, he mentioned how global central banks have now pivoted towards rate hikes, and economists also say because of the West Asia conflict going down the financial year in December policy, from December policy onwards, we may start seeing the repo rate being hiked by around 25 to 50 basis points. Now, key takeaway number 3 was that RBI governor specified that India's gold reserves are intact. India has not sold any gold. We have enough forex reserve to tide over the current crisis, and this will be a lesson for future crises as well on how to manage your forex kitty to deal with such external conflicts. Now, key takeaway number 4 is that RBI is yet to get access to Mythos, which is one of the most talked about new AI model in the banking industry. It can spot bugs in a real-time manner, and all the bankers and regulators globally are working towards assessing the threats that this particular new AI model poses and its abilities to extract bugs. Now, key takeaway number 5 is that RBI governor has said that the upper layer category of NBFC list, the updated one, will be issued soon. This is a very important subject because, as we are aware, Tata Sons has applied for a deregistration, and that deadline to list has already passed in September 2025. So we have seen this 7-8 month period where the RBI has actually not commented anything on this front. So it will be interesting to see if Tata Sons names comes out in the upper layer list of category.
All right. Thanks so much, Piyush, for stating that and giving us the takeaways. Well, markets ended Friday's session in the red, with the Nifty slipping nearly 0.2% amid the weakness in metal and IT stocks. And for the week, Nifty fell 0.7%, marking its second consecutive week of losses. Well, the broader markets, they were mixed. The mid-cap 150 index declined 1.2%, snapping a 2-week winning streak, while the small cap 250 gained nearly 0.5% to extend the gains for a third straight week. Amongst the sectors, well, the PSU banks outperformed, while FMCG, pharma, real estate, defense and IT stocks remained under pressure. So not much movement when it comes to the market today, but a lot of work done in the money market as well as bond market and the monetary policy. With that, it's a wrap on this edition of Profit 360, but do keep it with NDTV Profit. Lots of news and views lined up on the other side. Thank you so much.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
We'll be traveling back to Delhi first thing tomorrow morning, where we'll be meeting with Minister Goyal, and we're very optimistic. Look, we're 99% there. The last 1% we're working on.
So SBI AMC, is there a timeline yet for the IPO?
We hope to do sometime during this year. Okay. We are just waiting for the regulatory approvals.
In the near future, it looks sustainable, but it all depends on the environment and the war. So if it really deteriorates and one doesn't have any idea of when will it end, every day you get hopes and the next day the hopes are dashed.
There is a cost impact, and I would say there's a 100 crore cost impact, but I think that we've repriced some of our services to build in the inflation that's come from that.
But if you could give us some details about what that 1% is.
That's a great question. You must be with the media. How are you? What outlet?
NDTV Profit.
Great question.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. India Inc.'s most respected names chose India Inc.'s best and brightest.
I'm delighted to be chairing a committee of such distinguished fellow businessmen, bankers. It's just lovely to be back on this NDTV jury. I have been a fan of NDTV for a long time.
Many of the nominees are extremely close together in terms of what they've done.
Gender parity to be reflected while we choose leadership as well.
It's also important that how they are reshaping the industries.
We got a fantastic jury and we've left all decisions to the wisdom of the jury.
Who will earn India's top business honors? Find out on 3rd July at the NDTV Profit Business Leadership Awards. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information blitz into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and war. India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance.
Ms. Vashin, DG PIB, my friends from MOSPI, press and media people. Now this is the presentation after the base year revision. First time we are presenting on Q4 estimates and provisional estimate for 25-26. Next slide, please. In this presentation, it is mainly content is broad methodology, then data sources, then we'll discuss about the quarterly estimates of this Q4, and then overall provisional estimate of 25-26. Now before starting, let's first tell you the brief methodology for quarterly estimates. Next slide. What is done actually here in compilation of quarterly national account, we use that benchmark indicator method. In benchmark, we take the figures from the previous year's estimate and then we quarterize it first, and then after quarterizing, using certain indicator like some high frequency indicator related to that particular sector, we use to estimate that particular quarter's estimate. The indicators we are getting from various ministries, departments, states, private agencies while compiling these estimates. These indicators are very big in numbers, say about 180 to 200 indicators are used. Mainly for agriculture and allied, we use the production estimate data from Minister of Agriculture and Family Welfare, then Minister of Fisheries, animal husbandry data. Then for mining, electricity, etc., we use IIP coal, petroleum, natural gas, metallic, non-metallic minerals of IIP electricity, gas, consumption from petroleum and natural gas. For manufacturing, trade, hotel, real estate, professional service, and other services like health and education, etc., we use the listed companies' financial returns data as well as GST for indicator. Then for construction, we use the cement production index from DPIIT, steel consumption from Joint Plan Committee, then IIPs. Then for balance of payments data from RBI, then VAHAN data, then export-import from DGCIS, food grain bulletin for PFC, GFC, export, import, and also valuables. Then PFN's data for public administration, defense, and net taxes, etc. From IADIR for financial services. Then rail, passenger, goods, air traffic, cargo handled at ports and from Ministry of Ports, shipping, vehicle sales from SIAM, telecom data, etc. for transport and communication sectors. As well as we are coming out with the constant price estimate. For constant price estimate, we use the granular WPI, CPI, and unit value index data. So using these data, we generate the quarterly estimate, and provisional estimate for whole year is essentially sum total of this quarter-wise estimate. Next slide, please. Now, what we have found in the real GDP growth in quarter 4 estimate of 25-26, it is essentially, you can see in the picture graphs that it is a reasonably good growth rate has been found from the quarter 1 to quarter 4, and quarter 2 shown the highest 8.3%, whereas for this quarter 4 figure found to be 7.8%. It is essentially driven by the tertiary sector, which will come later, and all the quarters of FY 25-26 performed well. Next slide. Now, if we see the activity-wise, sector-wise growth in quarter 4, you will see that it is mainly driven by tertiary sector, that is trade, hotel, transport, communication, financial, real estate, which had shown more than 10% growth, as well as the manufacturing sector was also growing reasonably good at 7.3% in quarter 4, and agriculture and allied sector, which was also showing good growth compared to its past quarter 1, 2, 3, that it is about 3.6%, earlier it was 2.6%. Next slide, yes. Now, if we go to the expenditure component, then we will see that major share of expenditure is GFCF and PFC, which is about 85 to 90% share, and GFCF recorded about 10.8% growth, and PFC is 7.1% growth. And export and import was showing 3.7 and 1.9% in quarter 4 respectively in the 25-26. However, this was little bit lower compared to its earlier quarters. Now we turn to the whole financial year. Now, whole financial year, if we compare to SAE, it was 7.6% earlier, which was released on 27 February this year. Now it is, the provisional estimate is coming to 7.7% growth. And the 7.7% growth is consistent, and it is more than 7% is in the last several years. We are seeing that in 23-24 it was 7.2, then 7.1, then 7.6 in the for the same year in second advance estimate. Now if we see the sector wise, next slide please. The sector wise, then sector wise it is showing that manufacturing sector is showing a reasonably good growth rate, that 10.7%, and double digit growth was found in the first 3 quarters. Tertiary sector, that is services sector, shown a consistent growth of more than 9% in all the quarters, driven by mainly trade, financial services and professional services. Along with it, growth in agriculture and allied sector also recorded growth rate of 3.0%. Earlier it was 2.7%, and now updated production estimate of crop and fish information have been received, and accordingly this is, the figure is 3.0% for the agriculture and allied sector. Now if we turn to the expenditure component of this financial year 25-26, that contribution for PFC and GFC is about 89% in overall GDP. PFC is recorded 7.7% compared to 5.8% which was in the previous year. Now GFCF is the main instrument for growth. It is registered 8.2% growth, higher than 6.4% which was in the previous year. Now with this more or less estimates are over. Now along with it I would like to say that IIP is revised very recently and PPI is also coming. Then we will use this information for the 22-23, 23-24 and 24-25 till in the August estimate, updated estimates will be made available to you. And along with it, we will also provide the detailed methodology stating that quote unquote sources and methods we say, that will also be made available in August 26. Along with national account statistics of 26 will also come in August. Then the back series which we are working with is planned to be made available by the end of this current calendar year. So that's all. Thank you.
Summary results of the fourth quarter 25-26 and the full year data by my colleague in Mosby. We will now walk you through some of the finer details and also give a flavor of the opportunities and the challenges we face with respect to 26-27. Next slide. So if you look at the growth momentum, this slide was already shared by my Mosby colleague as well, and the quarterly breakdown, so I don't need to belabor this slide. We saw the post-COVID growth rates of more than 7% in the old series, and we are able to see that in the new series as well. And with the promise of incorporation of PPI and IIP data in August, I'm sure that some of these numbers will look even more well-grounded in terms of the GDP outcomes. If you look at the granular data, again, was presented by my colleague, but you can see that the gratifying thing is not only the pickup in services sector growth rate, but also the near double digit in 1 year, but more than double digit in the other 2 years in manufacturing growth rate as well. And if you look at the expenditure components, we can see that the private final consumption expenditure found its footing in FY26. And the more gratifying thing, as in the case of manufacturing, in the bottom left chart, you can see the gross fixed capital formation rate being 8.2%, which is a good pickup. And that continued in the quarterly numbers as well that we saw. So overall, I think it's a balanced picture with respect to the different components of the economy contributing to growth from the GDP perspective and also from the expenditure perspective. Now, obviously, this is the solid backdrop with which the Indian economy began to confront the February 28th West Asia conflict. So as we entered, and in fact, if you recall, on February 27th, Secretary Garg and I were there in the press conference related to the new GDP series. And at that time, I had mentioned that the forecast, or the estimate rather, for FY27, which in the economic survey we had placed at between 6.8 and 7.2, I was revising it to between 7 and 7.4, but then the following day, the conflict opened up. So now obviously we are looking at the various challenges, and the central bank this morning told us that they are revising their estimate from 6.9% down to 6.6 for the real GDP growth in FY27, but with the downside risk attached to it. And they also said that 5.1% will be the inflation rate from CPI headline basis for 26-27, and again attaching an upside risk to that number. That seems to be a fair assessment of the situation by the central bank, and we have no reason to second guess them at this point, because there are both possibilities on the upside and on the downside with respect to the numbers that they had presented us this morning. So if you look at the four different challenges we are facing, one is of course the energy shock. The crude oil prices are still, in relation to what one could have anticipated, given the amount of supply disruptions created by the conflict, the Brent crude is still trading below $100 in the financial futures contracts. But we also hear of a lot of physical market prices being much higher. At the same time, we also hear stories about a complete reduction in the imports of crude oil by China and the drawdown of inventory by the United States, etc., all of which are contributing to oil prices staying below the three-figure mark. But will it continue to stay below the three-figure mark and continue to decline as the financial futures contract suggests? Or will supply disruptions come into prominence in the second half of the Indian financial year, leading to much higher prices? And that will determine the course of both growth and inflation outcomes, not only in India but elsewhere in the world, both for calendar year 2026 and for FY27 as far as India is concerned. And what our government has been able to do is to ensure adequate availability of all necessary petroleum and petrochemical ingredients for the real sector. It is the prices that are globally determined that remain the uncertain factor. And the tanker traffic is still relatively scarce, almost close to non-existent. And the fact that 3 months into the conflict, there is no clear apparent pathway to a resolution, after which the removal of the mines in the strait will take place, and after which it will be open for tanker traffic, and then the supply disruptions in the petroleum and petrochemical complexes in the Gulf area will have to be restored before pre-February 28 normalcy, both in terms of production, export, and tanker traffic can be restored. So you can imagine the uncertainties embedded in all these stages that need to happen for the global economy and the Indian economy to be restored to the pre-February 28th kind of arrangement in terms of flows of energy across the world. So in fact, one of the things we closely follow is the US Department of Energy's Energy Information Administration, EIA, puts out a short-term energy outlook. And it is a monthly publication. In fact, the next one will be due next week. Now, what is interesting or rather concerning, depending on one's perspective, the supply disruption that they estimated for in the month of April, especially for the third quarter and the fourth quarter. In April, the estimate was that 2.2 million barrels per day of oil supply would remain disrupted. in the May edition of the short-term energy outlook, they increased that number to 6.4 million barrels per day. So 3x increase. For the fourth quarter, they had estimated a near normalization of the oil supplies in the world. But now they have estimated that the supply disruption will still be of the order of magnitude of 1.7 million barrels per day, which is a 10x increase. So given this kind of massive increase or upward revision to supply disruption numbers, we have to be mindful of the fact that the oil price remains still a big question mark as we go into the second half of the calendar year and 3 quarters of the financial year as far as India is concerned. But nonetheless, at the same time, as is the case with respect to global trade, there are positive surprises that global trade has remained resilient. Indian exports have remained resilient in the month of April. That is what the trade statistics tells us, because the core exports, if you take away the petroleum products and gems and jewelry exports, the export growth rate of merchandise was in double digits. And so was services sector exports. So, and early indications for May also suggest that exports performance remains strong, which is something not we would have expected given the disruption to global trade flows because of the strait. So there are a lot of things that are happening, moving parts, which we don't fully comprehend, both positive and negative. Therefore, it will be premature to come to conclusions about the direction that growth and inflation outcomes would take. And that is why we would refrain from giving point estimates at this stage from the Ministry of Finance side, but refer to the RBI's numbers released this morning as the base and work with their assumptions and downside and upside risks as stated by them.
Chief Economic Advisor of the country, and he was talking about the GDP numbers and where all the growth really came in from, beating the estimates for the last financial year, and especially the last quarter of FY26 has been a good news for the Indian economy. But remember, the projections that have been shared by the RBI are the projections which takes into account the impact of West Asia crisis and has been projected downwards. Dipti Deshpande, Principal Economist at CRISIL, joins in. Dipti, what do you make of first the numbers? And of course, that was a different economy altogether with different factors and pinpoints as well. But now with West Asia crisis, the new projected numbers, and how do you see the state of the economy on GDP front?
Sure, Nisha. Thank you for having me. Of course, it was a pleasant surprise to see that the FY26 number has been revised up, even though marginally. When you look at the internals, I believe it tells you a little more on the momentum of the economy. One is the underlying momentum, which will provide some sort of tailwinds, which will provide some sort of a cushion. At the same time, I think we've entered this fiscal year with 2 exogenous shocks, which are completely out of hand for us. Number one is naturally the West Asia shock, which, if I may say so, began as a supply shock in a way, but has quickly morphed into a price shock, something that's going to linger through the rest of the year and maybe a little beyond that as well. The second shock essentially is on the monsoon front, where we know relatively little about. We know for sure that it's going to be below normal. Beyond that, it's also important in terms of understanding how uneven it's going to be, how El Nino is going to make it more patchy, if at all, or if there are some counterbalancing forces. So clearly, I think there are these 2 forces which are going to play a role. And as they play a role, our estimate is that this year, FY27, we will see about growth at about 6.6% or so. Much of it comes in because of this hit. There will be some production related hits, that we see in Q1. So Q1 of FY27, in fact, will be a bigger growth number to really talk about, because it will have both forces from both sides playing out. One is the fact that supply shortages will lead to some downside on production. Number 2, towards the end of the, this particular quarter, we will see prices having an impact. So when you look at GVA, which is gross value added, that should also look much more slower in terms of growth when you compare it to the previous quarters.
That's right.
Having said, yeah.
So, Deepti, a very important PowerPoint that you touched upon. Of course, as I am seeing it, the full impact of the war crisis will impact us in the first quarter of FY27. And the next quarter, that is Q2, will have a large part of the El Nino as well as the lower than expected, lower than normal monsoon. How do you see the 2 quarters and what could be the in-house projection on the GDP numbers, Deepti?
So our GDP numbers are pretty much aligned with what the RBI also rolled out. They would be around 6.5% or so in the first half, sorry. I think we are speaking about the supply side factors when we talk about the West Asia impact, and we speak about the monsoon impact as well. But equally important is that the first half of this fiscal will see support on the demand front. Why do I say so is because we have tailwinds from IT reductions of last year, GST reductions of last year, as a result of which those remain supportive of demand at least until the first half of this particular fiscal. To add to that, we've seen the gross fixed capital formation number, and we believe government spending, capex spending will remain robust this year too. The other factor which is also pretty important, especially given the fact that we're talking about higher retail inflation, purchasing power and all of that, is that we have about 16, 17 states delivering large cash transfers to the populace. And I think all of these are demand supporters in some way or the other. So yes, I think this year is going to be a complex year where supply shortages, price increases, etc., will have an impact on purchasing power and demand to some extent. However, some of the tailwinds from fiscal measures already announced last year will provide that downside to growth. Having said that, our 6.6% GDP growth also has downside risks to it, and all of that essentially depend upon these 2 exogenous factors that I mentioned about.
All right, Deepti, many factors to really watch out for. But of course, next 2 quarters, GDP numbers would be on the watch with many factors impacting it. And thank you so much for giving us that snapshot of your expert take on the GDP numbers that have been. It's a beat. It's a time to probably celebrate, but the world has changed with many external factors impacting the economy. And therefore, the GDP estimates that have been incorporating the West Asia crisis, as has been stated by the Reserve Bank of India. With that, it's a wrap on this show, but keep it with NDTV Profit. Thank you so much for tuning in.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices.
And here's where you can watch us.
Be traveling back to Delhi first thing tomorrow morning, where we'll be meeting with Minister Goyal, and we're very optimistic. Look, we're 99% there. The last 1% we're working on.
So SBI AMC, is there a timeline yet for the IPO?
We hope to do sometime during this year. We are just waiting for the regulatory approvals.
In the near future, it looks sustainable, but it all depends on the environment and the war. So if it really deteriorates and one doesn't have any idea of when will it end, every day you get hopes and the next day the hopes are dashed.
There is a cost impact, and I would say there's a 100 crore cost impact, but I think that we've repriced some of our services to build in the inflation that's come from that.
But if you could give us some details about what that 1% is.
That's a great question. You must be with the media. Are you? What outlet?
NDTV Profit.
Great question.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. India Inc.'s most respected names chose India Inc.'s best and brightest.
I'm delighted to be chairing of such distinguished fellow businessmen, bankers. It's just lovely to be back on this NDTV jury. I have been a fan of NDTV for a long time.
Many of the nominees are extremely close together in terms of what they've done.
Gender parity to be reflected while we choose leadership as well.
It's also important that how they are reshaping the industries.
We got a fantastic jury, and we've left all decisions to the wisdom of the jury.
Who will earn India's top business honors? Find out on 3rd July at the NDTV Profit Business Leadership Awards.
Out of the many topics that we have conversations about on this platform, there's one that is by far and away the most divisive, and that is real estate. You say that for a large number of people, at least till they're of a certain age, it makes more sense for them to rent than to buy, and you'll have thousands of people telling you that you have no idea what you're talking about. And yet, the buying of a house is fraught with danger. And that is because it is very likely to be the most that you will pay for anything in your life. I've been looking forward to this conversation on MoneyWise, and that is because the person that I'm going to speak to has significant insight on real estate that I'm definitely going to benefit from, and I think you can too. Vishal Bhargav, a real estate media professional and host of our newest show, The Habitat, joining me today. Vishal, thanks so much for taking the time.
Thank you, Alex.
So let me start at this, at the question, right? There is this tendency, like any other asset class, to paint real estate with the same brush. Should you definitely not do that?
Well, you can't do that. Just like in stocks, you have your small cap, mid cap, large cap. In real estate, it's broken down into many more segments. So there's at the country, then city, within a city, micro markets, within micro markets, even a building. So you have to be very careful as to how you assess a market. Can you do it with a broad brush? Absolutely not. But there are some inherent patterns that in a way govern all the real estate micro markets and possibly sometimes the entire city as well.
What are those common factors? Because ultimately, obviously, it is real estate.
So see, the biggest factor is sentiment.
Okay, real estate is sentiment, sentiment, sentiment. If you feel optimistic about the future, you will buy. If you feel pessimistic about the future, you most likely will delay or not buy. So sentiment overrides everything. So sentiment is the deal breaker, okay, or the deal maker in many cases. After that, it comes across as to, is there a good project for me? Is there a good builder for me? Is there a good price for me? Invariably, all those three never come together, okay. But you have to do the compromise. It's like the impossible trinity. You have to see maybe two out of three work. If 2 out of 3 work, most times the job gets done to the satisfaction of the developer and the buyer.
Very interesting that you're saying that. So therefore, while there are commonalities between real estate and other asset classes, and you drew parallel to equity, can it be said, however, that you have to look at it differently? In that, if I look at a real estate project, can I compare it to what Warren Buffett says about equity? You buy when others are fearful and you sell when others are greedy. Does it work like that?
I would discourage people from that philosophy. See, the thing is, I'm sure the legendary stock investor has a very nuanced reason for his point of view. In real estate, I would suggest when things are really shaky, you should behave like a rat. You jump. Okay? Because in real estate, the cycle to recovery is very long, painful, and it is fraught with too many legal complications. Unlike in equity, where you buy a stock and there is scope to, in a way, liquidate some part at whatever price point. Yeah. In real estate, it's one asset. You either have that or you don't have that. Yeah. So you're all in. Yeah. So you got to be very careful when you get in, because getting out is very tough. In this regard, I will disagree with the legendary investor for real estate. The way you should have to approach real estate is, if I have to give it a stock market analogy, and since yours is a stock market platform, is that if you're buying a under construction property at an early stage, think of it that you're buying a small cap stock.
Okay.
There is a healthy upside, but there's a healthy amount of risk as well. Then if you buy it at a mid-level construction stage, think you're buying like a mid-cap stock. Okay.
Interesting.
And then if you're buying it at almost completion, you're buying a blue chip stock. The upside is very limited, but it's more, you want steady appreciation, so on and so forth. Once you buy it after OC or after completion, think of it like a fixed deposit. It can't go wrong, but it'll give you those sort of returns. Inflation indexed in a way.
Interesting. So therefore, I think the original objective when you're buying the real estate needs to be identified. Are you buying it because you want to live in it? Or are you buying it because you want to diversify, or you think that real estate is the next best investment to make? Can real estate be an amazing investment in the residential market in India?
So residential market, it can be, but it's very tough. It's not as easy to find a very good residential opportunity in terms of investment in the Indian sphere. The best investment opportunity invariably comes across in land.
Sure.
Okay. Because the cycle is pretty simple, that if you first buy it in, one guy buys it in land, then he sells it in square meters, then the eventual guy buys it in square feet. The big play happens over there, right?
Yeah.
You buy it in one denomination, the price optically looks lower when you buy it in per square feet. So in that regard, I think the clear focus, if someone has to buy residential real estate, he has to be able to pick those hidden gems. And there are like 2 or 3 formulas that are there, but not too many beyond that. And somebody will often think that, is it worth taking the risk when the return is not substantial, but the risk is high?
So why do you say, though, that residential real estate, the opportunities don't exist? Because, look, the stories are galore, right? And everybody has anecdotal evidence of that. One family member that comes to the party and says, "मैंने 1998 में घर इस value में खरीदा था, अभी देखो, it is so many crores." It doesn't work that way, does it?
No, it works that way. See, the thing is, we only hear about the good stories.
Yeah.
We don't hear about the bad stories because, there is... Everybody likes to talk about their successes. So that same relative uncle who says, I made 5x by buying this property, he probably won't tell you that he bought a piece of land that is now stuck in litigation.
Right.
So what happens is, because people don't talk about the negative stories, it becomes a self-perpetuating narrative. Because everybody is saying that, only good stories. Because the bad stories invariably come out only when shit has hit the floor, right? The only time, see, one of the problems in real estate is that, and I say this about scandals a lot, that in real estate, 9 out of the 10 scandals don't ever come in the public domain, because it becomes in the interest of the home buyer to not make it public, even though he knows he's been scammed.
What are the kind of stuff that you've come across?
So see, one very interesting one that I found was, just when somebody buys a home, there's an architect certificate you have to get to make sure that you do your next disbursement, okay? Because payment happens based on slab, right?
Yeah.
So somebody says, now 10 slab is there, so make the next disbursement. Then 13 slab is done, 13 floor is done, so make the next payment. One very interesting case I saw in Mumbai some time back, where the architect certificate was only forged, the person paid up to the 20th floor, but the building was at the plinth, was at the ground floor.
But didn't they go and check?
See, okay, now I know a lot of people say this, that buyers should check, but the buyer's point of view is, and I don't fault the buyer for this, is that one is the builder is giving you the document, the architect is providing that document, which should have sanctity, otherwise he can lose his license. The lender has been given this document, so somebody in that chain would have ideally verified.
Sure.
But everybody thinks that the other one will do it. But the one holding the can is the buyer.
My goodness. I wanted to talk to you about risks, and I think this is an opportune moment to do that. You likened buying an under construction property like buying a small cap, and I think to a large extent people won't really relate the two, because let's face it, and Vishal, you probably know about this, we're going to say it anyway. After COVID-19, people bought a lot of small caps, and they've borne the brunt of that over the last 2.5 years, because the small cap space as a whole has gone through its own cycle. So maybe that's not an analogy that's going to hit. So basically you're saying that it's fraught with risk. It's a lot of risk. Why do you say that?
See, early stage under construction, to be fair, you can't blame in India developers also to a large extent. I know a lot of people think I'm very anti-developer. I'm not anti-developer. But when you're buying under construction, invariably, there are so many variables for a developer also. There is some government guideline, there's some judiciary regulation, there is some green tribunal who says something, and the project comes to a halt. Okay, like last year, example, we didn't see many launches in Mumbai because of a environment clearance holding up projects beyond a certain size.
Sure.
Now people have factored in that, I'll take up this project, I'll launch it on so and so date. But what do you do when there's a regulation that blocks you from doing it for 6 to 9 months? So it's partly the developer's fault, to the extent that he doesn't plan his finances. But there are many things outside of his control that come into play. And if you buy early and the project gets stuck for a year, the typical model you have to go in your head, at least now in Mumbai real estate, is that if your project is stuck for more than a year and a half, there is a very strong likelihood the developer will not make any money in the project. Sure. And if he'll not make money in the project, there's a very good likelihood that he'll compromise on the project, either in the quality or in the delivery.
Okay. But aren't you protected by the RERA, by the Real Estate Regulatory Authority Act?
See, RERA has been a boon for the real estate industry, for the home buyer. But see, RERA is still a quasi-judicial body. It doesn't have enforcement powers. And one of the unfortunate realities about Indian real estate is that many developers have a bigger legal team than a construction team. So they don't mind fighting it out in court, even if RERA rules against them.
Oh.
So RERA is, I'll put it this way, RERA provides you limited safeguards. Is it completely useless, as many of the critics say? No. But is it that, is it the silver bullet that has come to the rescue of home buyers? Absolutely not.
Okay. The reason why people gravitate towards buying under construction property, ultimately, my judgment, and you tell me if I'm right, is affordability. And the fact that it's available at a significant discount to what you would get. And you liken that for good reason to buying various types of investments, right? Limited upside. Some people take a punt, and you probably have good understanding of that in certain micro markets. But a lot of people in Mumbai, in certain other pockets, will do so because there's a very big difference. Is affordability a major problem in metro cities?
See, affordability is a very big challenge. The biggest challenge is there in Mumbai and Gurgaon. Gurgaon more than Mumbai, I'll say, at this point of time. But see, a lot of people buy homes at under construction stage because they have this illusion that under construction homes are distinctly cheaper than ready homes.
Are they?
So, in many cases, they're not. I'll put it that way. And they are not, the gap is not as wide as people perceive it to be. Okay? Because when you buy something at under construction, you have to be very, very clear. In my experience or my knowledge, I'll say that unless you expect your current price at under construction to be at least a 30% discount to the expected final price, don't buy it. because that 30% is the least amount of cushion you should have for taking that risk.
Let me ask you this, okay, what is the normal, I guess it would be different based on different sizes of construction, but if you're talking about a normal construction in the city of Mumbai or in Gurgaon or in Bengaluru, what is the normal time for the completion of a project?
See, Mumbai is the longest because we go very tall.
Okay.
And if you go very tall, you have to first go very down in the foundation.
Right. Yeah.
So I think for a 60-floor building in Mumbai, it'll take about 5 years.
5 years, okay.
Gurgaon
From the breaking of ground to everything, approvals and all of that.
Gurgaon is bonkers. Gurgaon will do that same thing for maybe 30-floor buildings. Okay?
Oh, okay.
But then Gurgaon has a different ecosystem in terms of the model that they follow. In Mumbai, the builder constructs for the end user.
Sure.
So he wants a home quickly.
Right.
In Gurgaon, the builder constructs for the trader or the investor who wants the cycle to be longer so that he can exit.
Ah, okay.
So Bangalore, in my view, is the best actually. Bangalore.
Because it's quickest, you're saying?
It's quickest. So Bangalore, in a way, tells you where Gurgaon lacks.
Okay.
Because you have similar number of stories typically done, 30 floors, 35 floors. They do it very quickly.
In 3 years.
3 years, fast, very high efficiency, and they get the job done. They don't spend too much time in advertising first day sellout and bonanza, some Bollywood actor dancing at the ceremonies and all. They're very clinical in the operation. So I think if you have to ask me one market that most major cities should learn from, in my view, it will be like a Bangalore or a Pune.
So here's the thing, right? And my follow-up question to that, if you're talking about a good developer and this idea that you're not going to get an option or opportunity down the line, if you don't book a flat in the opening stage, it's going to get sold out. Is that a fallacy?
Yeah, that is
artificial scarcity.
No, there's no scarcity. I'll put it that way.
Artificial or otherwise?
There's no this. See, the thing is, you're talking about Mumbai here. You're talking
Mumbai generally.
See, okay, I'll put it this way. In Mumbai, there is no artificial scarcity. Okay, there's no scarcity. Developers are very clear as to how much is sold out, how much is unsold. Okay, which is why we don't see too many of these first day sellout boards over here, right?
Yeah.
Gurgaon is the opposite. I agree. If your reference is to Gurgaon, in that I agree.
True.
That I agree. Because the thing is, you have to create artificial scarcity for the belief or the narrative to be in the air that there's no supply, and suddenly I hold that one unit and every unit becomes more valuable because of that. So you have to think of, in a way, Gurgaon real estate like how, the old time movie theaters used to announce sold out, house full.
Sure.
It is house full, but outside the black market is selling.
Sure.
Okay. Now I'm not saying that the trader is a black marketeer, but the illusion has been there. This is a house full movie. That means it's a hit. But outside you're getting lots of stock.
Or an automotive company saying, first day I'm opening my thing for 30 minutes. Oh, I'm sold out. You could have actually produced more units.
You could have. True. So here it's similar to that. You have to create that FOMO and all. But every city goes through that. Okay. A few weeks back I was chatting with Prestige's Irfan Razak, and he was telling me that in the 90s they had the same stunt that they tried, but they've learnt that it backfires over a period of time, because it's eventually, iski tope uske sar.
Sure.
In that regard, if you are stuck, you don't get the money, the project goes to a limbo.
Yeah.
So Gurgaon will also learn and adapt to it.
Okay, so the purpose of that conversation, the last two questions rather, was the opportunity cost. In economics, in personal finance, ultimately that's the first thing you will look at. If I'm not going to book a project at that early stage and wait for that 3.5, 4, 5 years, what would you do with that money? So you can actually invest it in a mutual fund or otherwise, and spend that 5 years, even if you get a 10 to 11% compounded rate over the next 3 to 5 years, you're well placed, and you can then take a loan down the line, and you're well served, aren't you?
You can. The only difference between equity and real estate in this regard is that in equity you have to put all the entire investment upfront to get that return.
Yeah.
In a real estate project, you buy a 2 crore home by putting in 40
leverage.
Lakhs. Yeah, so you're getting, if it goes up 10%, you're making 20 lakh rupees on a 40 lakh investment.
Yeah.
So the other reason people buy early is because they say, I want my choice of inventory. To be honest, I've never quite understood this reality, that when people say, I want it for my inventory, there's so many buildings coming across. You want exactly that particular, I want 9th floor, this facing that. I mean, I sometimes I don't believe most people when they tell me that I did it because of inventory reasons. Most of the times it's actually the price or the illusion that you're getting at a lower price for people to get into it.
So let's talk about price, because this is assuming that prices will always go up and will never fall. Is that true?
Anyone who tells you that prices never fall is either a broker or does not know real estate. Okay, so in fact, I often tell people that the way to check who's a good broker is that ask him this question: do real estate prices ever fall? If he says no, they never fall, he's not your broker. Get out of the room, find another broker.
Run away.
Because then you have to know if somebody's a broker, whose side is he on? Because if he's on your side, no, he will always
get you the best price.
He gets the best price. But if he tells you now that prices only rise, then you know he's not batting on your behalf, because he'll tell you whatever price is available to you, buy it now because it'll only rise.
Right.
So be wary of the broker who tells you that home prices never fall.
But okay, so never fall. When are the instances that you've seen big falls, right? You've seen it in micro markets, certainly. Around the financial crisis, the global financial crisis, there was a crash and then it got bought into, and that rebound took place very quickly. I don't know, did it happen COVID? I don't think it did happen COVID-19. You haven't seen big falls, right?
No. So, okay. 2008, that was a sharp hit that happened. Then from 2015 onwards, we saw what I call painful death or slow death.
So time-wise correction.
Time-wise correction, but that hurts more than an instant shot.
Yeah.
Okay. What happens in that case is that it's, when you get an instant shot, you have to bounce back. What is more painful for a developer often is, that hope. Next month will get better, and it never gets better. It's like that. It's like that patient who's there in hospital for so long, hoping he'll recover. He doesn't recover. It's painful. It's expensive. Versus somebody who gets in, gets their surgery done, gets out, gets back healthy. So we saw that phase between 2015 to 2020. In COVID, for the first 6 months, things fell off very sharply. The type of deals that have come to buyers.
Oh yeah, they did actually, because there was panic at that time.
There was panic, they sold, and I think builders behaved, for the first time in at least my memory, they behaved very nimble-footedly. They gave good deals, good offers.
I remember the conversations were, you sit across the table and we'll give you a good deal. It was not advertisements in the paper saying, hey, discount sale, etc. But you sit across the table and say, you know what, give me 5% less, 10% less. I'll pay up front, etc.
Yeah, so I think, to be honest, right now we're also in the same zone.
Okay, we are.
We're already in the same zone.
Interesting.
Because see...
In Mumbai or?
In Mumbai, Gurgaon. For them. In smaller markets, even more actually. See, the thing is, in most of these markets, you have to be very careful as to how you really judge your developer. One of my big disappointments with the COVID has been that, I saw that brief phase where I noticed many developers becoming very humble and very buyer-driven. Unfortunately, what happened is in 21, the market sort of started recovering, and 22, 23, it was strong. So most builders escaped the that pain, and they've in a way gone back to that old zone of treating buyers as very dispensable players in the ecosystem. But for that 6 or 7 month period, I could see that builders were introspective. We should have treated the buyer better. We should have committed right. We should have. But right now, if you talk to the same people who were giving those conversations on webinars, their tune has changed fully. They've gone back to that same arrogance that created the crisis in the first place.
So out of the impossible trinity, one of the factors, of course, was choosing your developer. And a lot of people gravitate towards the tried and tested. There are a few that are blue chip names, so to speak, for good reason. Are you taking a significant risk by choosing to not go, because they command a premium as well, Vishal?
See, blue chip I'll tell you what. A blue chip in Indian real estate does not mean you get a great product.
Okay.
It just means you'll get the product.
Okay, you're guaranteed of delivery.
You're guaranteed of delivery, not the quality of the delivery.
Okay.
And the proof of that is in one of the largest developers who's listed also on the stock exchange, having constant issues on his product quality that his buyers have been raging about, both in Mumbai and in Gurgaon. Okay. So it is unfortunately the benchmark of an Indian home buyer is so low that he thinks mere delivery of the house is an achievement, which is why that premium versus a branded developer versus an unbranded developer can be as much as 25 to 30%.
Yeah.
But when you get the product, you don't feel that.
Yeah.
Which is why there's this backlash from home buyers who think that, I paid 30% extra, and what do I get? The tile peeling off from here, the construction quality being weak. So I think this is the next stage of the evolution of real estate, where I think branded developers will have to learn that just giving homes to the buyer will not be enough. I'll have to raise the quality as well.
So therefore, and I'm sure that there are plenty of unbranded developers that are giving very good quality at this point. How do you find them?
So see, every branded developer is not a good developer, but every unbranded developer is not a bad developer.
Sure, yeah.
Okay. So you have to go and look at the track record. Many of these unbranded developers don't believe in spending money on marketing, branding.
Word of mouth.
You have to go and see his last 5 buildings. I think that's, there are only 3 or 4 ways you can segment how to choose. One is, if I want to know the track record, go and see his last few buildings. I'll know what is to be done. If I want to know his intent, read the legal agreement between the builder and the buyer. In that, you'll always find enough clauses that will give you suspicion as to why is he putting that there in the agreement. He has a plan B, plan C, plan D. If you want to know the developer's financials, his capital capability, go to that developer's lenders to understand what rate they are giving him money, what terms they give him money.
Yeah.
If it is something very, very expensive, they have a very high risk placed on the developer. You should have the same risk placed on him.
How much do you have to peruse the documentation in that? The original plan, the sanctioned plan, what has actually come through? Because I've heard of stories where one balcony is shaved off, or something is gone from the original sanctioned plan and now that's no longer there. That happens quite a bit, doesn't it?
That doesn't happen as much now, though
it used to happen.
Yeah. I agree with you. It used to happen. See, earlier it was the Wild West. In that regard, I think RERA has played a very strong role in ensuring that we have at least got our plans in place. People still make some changes if they get consent of the home buyers, to arrange things. And see, unfortunately, what happens, most home buyers give a consent because after a certain stage of construction of the project, the home buyers have more skin in the project than the builder himself.
Yeah.
So it's one of those very ironical dilemmas where, he is the developer, it's your money, but he has more power.
So coming to the last part of this conversation, which is that real estate, and you mentioned this as well, liquidity is a big issue, right? And if you're investing in real estate, you're not guaranteed your price because ultimately beauty is in the eye of the beholder, and the buyer will always come and say, hey, you know what, this is not working for me. I'm getting a new property at XYZ, so why should I buy this? Give me a 20% discount or 15% discount. Depending on your desperation, you will agree with it. Any advice for people looking to sell in the secondary market?
See, if you're looking to sell, you should always, the first problem comes is you have been told a wrong price about the value of your apartment. Okay. You think your value of your apartment is 5 crores. Okay. Who tells you that? Your broker.
Right.
Okay. But the thing is, you have to tell your broker, you don't have to tell your broker whether he's the buyer or the seller. Okay. If you tell you are the buyer, he'll tell you the high price. If you say the seller, it's a low price.
Right.
So you have to know how to get your message out to know the true value of the property. Most times buyers go wrong is that they believe their value is overpriced because some bugger has told them, your rate should be 5 crore or 3 crore or 2 crore. And that's not the real rate.
Yeah, it's inflated.
And the true test of your property is when the broker tells you now your property value is 3 crore. Said, okay, I'm okay selling it for 2 crore 98 lakhs. Get me a buyer. Most times I've seen the broker can't manage that. Then he will spin those stories. Market is very low. There's this Iran war going on. Crude prices have gone higher. There's so much supply in the market. Interest rates are going to go up. Blah, blah, blah. Then the stories come on. But the way you have to judge it is that you have to believe no one. You have to talk to enough people and then get a calculated perspective on what your value holds. Don't be needlessly greedy. Most cases I've known where buyers go wrong. The property value is 2 crores. They stick on to 2 crores for 2 years, 3 years, 4 years and gets that same amount.
Yeah.
If you believe your property will not appreciate meaningfully, sell today, get out. The opportunity cost is very high. Yeah, it's very high.
That's the bottom line. It's been a fabulous conversation, Vishal. Thanks so much for taking the time. And I'm looking forward to seeing more episodes of The Habitat, and I'm sure everybody else tuning in is as well. Well, like I said, that brings us to the end of this edition of MoneyWise. Thanks so much for tuning in, and stay tuned. Lots more coming up on NDTV Profit.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
We'll be traveling back to Delhi first thing tomorrow morning, where we'll be meeting with Minister Goyal, and we're very optimistic. Look, we're 99% there. The last 1% we're working on.
So SBI AMC, is there a timeline yet for the IPO?
We hope to do sometime during this year. We are just waiting for the regulatory approvals.
In the near future, it looks sustainable, but it all depends on the environment and the war. So if it really deteriorates and one doesn't have any idea of when will it end, every day you get hopes and the next day the hopes are dashed.
There is a cost impact, and I would say there's a 100 crore cost impact, but I think that we've repriced some of our services to build in the inflation that's come from that.
But if you could give us some details about what that 1% is.
That's a great question. You must be with the media. Are you? What outlet?
NDTV Profit.
Great question.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet.
Well, hello and welcome to our special offering on Fridays, the Editor's Cut, wherein we try and talk about what we think as the key outcome of the developments that have happened in the week, and then get in our guest editor to try and weigh in on whether she or he agrees with the three argumentative Indians on this table or not. And guys,
Speak for yourself. I agree with everyone.
yeah, well, I can safely say first-hand experience that that's not true. No, but frankly, if we thought that we want to talk about the week, Friday told us that you might as well talk only about Friday and you will end up talking about the week. So in some sense, for me, the key takeaways as I looked through the week, and I heard you guys say that the mid-cap index has had a bit of a profit booking, so the parallel bull market this week has not turned out to be true. But the big expectation was the policy, and I think the policy was an expected line. So policy was an expected lines per se, the hold, etc., etc. But the moves on taxation are really, really encouraging. And, our cheat sheet, because I was talking to Sridhar Shriram just before the show started, you guys were anchoring, and the numbers that he has in store for what the inflows could be like are very, very encouraging. So that is one good thing. I would suspect, and I don't know how you guys think about it, but I would suspect that we'll probably have a series of other steps accompanying this, which might help the the inflows and the sentiment. Though there's a story that's floating around what could happen for brokerages in terms of margin funding and the capital that they put in, etc., and stuff like that. And if that were to turn out to be true, it could be an overhang for that particular
You mean
sector.
the margin trading facility deadline?
Yes.
On 1st July. But that's confirmed.
Yeah.
It's not being extended.
And the other moves that come in for prop trading, etc., and the capital that they have to put up, if all of that turns out to be true, it's a bit of a problem. So therefore, the simplest argument that almost everybody's making on the street is the rupee depreciation brings about losers. Don't focus on them. Look at the gainers, look at winners which benefit out of the rupee, and therefore look at the exporters, look at textiles, look at auto ancillaries, maybe at some point of time look at IT. I think that seems to be the simplest investment argument that one can make right now.
You know, to some extent, yes. But the way I was looking at it is, with the measures that have been announced, you are seeing a structure which is strengthening. And from what Tamanna just started off, India Market Close as well, where she categorically highlighted as well, which is absolutely right, that the markets are not really looking at the positive picture yet. And that's the reason why we saw profit booking. Because if you see the euphoria that we've seen pre-policy, somewhere you can say the markets have given that away to some extent, because we've traded actually kind of at a razor's edge, is what I would say, in the last 4-5 trading sessions. Now, there have been defensive capital shifts that are happening as well in terms of individual sectors. Look at metals and tech. Both of them high-flying sectors, they've given away gains. Your multi-sector rally that you were seeing has given out a breather right now. So that's from the market side of it. Now, if you look at the RBI, it's kind of a reality check as well, because your multi-billion-dollar regulatory and tax relief package that has come in for the FIIs. However, the unanimous decision that we're talking about, to add to that, you've slashed your growth outlook for FY27. You've increased your inflation forecast. So the counter argument to that is, on growth and inflation front, are the FIs, if they're going to come into the country, are they going to be okay with that kind of a structure? That's the argument where everyone is talking about right now, and the ifs and the buts. But yes, the structure, the path that they are taking in terms of the RBI is absolutely positive. But the moment other measures do come in, that's when probably there will be an answer to this question.
But the standalone is good, right? I mean, what they've done, standalone
it is
a really good move.
I think people are obfuscating what they want with what they need. Okay, so let me explain this. And this happens sometimes because you want to eat mithai, but actually you need salad. So it might be a weird comparison, but what the market wants is LTCG hata do, make things very attractive. You know, you want that cheesecake served to you. What you need as a nation is a high fiber diet. And you know, I'm thinking about that because I'm going into the weekend, which is always very tough. So pardon me for that. But you need to get a good, steady diet of protein, which will keep you going. That's what this kind of foreign flows will look like. So, I mean, here's my take for the week. India's countermeasures, in my view, have just begun. And I completely agree with you, Neeraj. In fact, a lot of reports doing the round, the top ministries have been asked to compile information on what we are doing, and there will be a lot more in the coming week from India's side officially that, hey, here's our plan. We've been quiet so far as a nation onto what our plan is to save the economy. There haven't been much out there publicly. I think that's about to change. Today was just day one. The fact that this measure, which we saw today, was brought in by an ordinance, in my view, is significant because it shows that there's urgency but not desperation. Why do I say that? Because the way they choose, the form and fashion in the way they chose to communicate is also important. It was through the Reserve Bank of India's monetary policy and the measures that they are taking. Remember, the ordinance and the Gazette came out at the same time as the governor was giving out his speech. So that also tells me that there will be a very calibrated move to put out this information and this communication to the wider cohort of global investors that India is now talking to. I honestly believe that the significance of this PROI announcement has been overlooked by markets today. What is PROI? Person residing out of India. And this individual entity can now invest 10% in a listed entity instead of 5% earlier. This is mistakenly by some being likened to the NRI bonds scheme of 2013, saying we're coming back with it. Well, it's not, because your cohort of beneficiaries is now beyond NRIs or anyone related to India, right? It's person residing outside India. Technically, that could be anybody, any individual entity, and not just a non-resident. And that increases access to capital markets and goes beyond a high-yielding debt instrument for the rupee, the way we saw in 2013. When we're talking about the rupee, we saw a huge recovery. I mean, that was the star of the show today, going past, strengthening past 95.
You could call it the standout victory of the week, I would say, probably.
Yeah, in one day, you know, some of that pain was over. For whoever is planning to buy dollars and travel in the next few days, good for you, and too bad if you've already done that exchange. But anyway, that's on a lighter note. I truly believe that recovery journey may have just begun, and this is unlikely what we've seen so far to be the only weapon in the government's arsenal. Expect more fireworks in the days to come. And that's something we'll be speaking to Sridhar Sivaram in a bit just now as well. And he's just walking in as we're seeing. But you know, even as we're talking only about Friday, because Friday was such a banger of a day, what an interesting week it has been, because it has been, as we've been calling it, conference season. We've been meeting so many investors, and one of the top market guys I met at one of the recent investor meets, it was a corporate investor meet, I asked, itna mood kyun kharab hai market ka? The answer was, kahan kharab hai? Kahan hai mandi? Mujhe to nahi dikh rahi hai. That's not necessarily what everyone is saying. Many people are a little muted, but is that the right answer or not? I don't know. Sridhar, hi, welcome.
Hi.
Welcome, please.
Thanks for inviting me.
This is how we do it at NDTV Profit. We capture you coming all the way in, and thank you so much for being here.
No, thanks for inviting me.
Has the RBI and the government of India actually over-delivered on what was expected as a measure to bring back foreign investment, or have they under-delivered?
They have delivered for sure.
Okay, that's true.
Yeah, so I think it's, as we were discussing before, that what they have delivered on the debt FI taxation is very good. It doesn't mean that you get inflows immediately, because you have to keep in mind that the US interest rates at the 10-year is close to 5%. You look at some of the corporate bonds that you can buy there, you could easily get 6.5 odd percent. But this will come over a period of, so some of the irritants have been removed. Passive funds can easily come in now.
What does the effective return become after all of these tax incentives, if in case you've done that math for any FPI?
The effective return will be the return that you get on the bond. Exactly the same, because there is no, earlier you had a 20% TDS or a withholding tax, and you had a capital gains. Now none of those, neither of them are there. So the return is exactly the same as, except for the currency. And in my view, if you look at the RER of India, which is and we are at around 88 right now. The last time we were around this range was in 2013, which was the taper tantrum, the fragile 5. So clearly we are, undervalued right now. So if I was a foreign investor in debt, and I look at the RER at 88 or 87, and I look at all the measures that the government has done today, I'll be tempted to invest in the debt securities, in the government securities today, with a view that the currency, if you ask me, I'm not an expert on currency, but you could easily see a currency appreciate, not depreciate for almost 12 to 18 months, given where RER is right now. And the history tells you that the currency appreciates when RER reaches such levels. And we saw that in 2013 also, the RBI and the government took a lot of actions. But eventually the currency will depreciate, but currently we are undervalued. That's how I look at it.
The point that you made with RER as well, at that point in time, if I'm not mistaken, oil was at around $100 as well. Right now we are below that. If you have to look at the interest in terms of the Indian bond markets versus what corporate bonds are offering in the US, does the math still fit in well, where you will be able to actually attract that quantum that we've already lost?
So when I look at what they have done on the FI debt side, then I look at what they've done on the ECB side and on the FCNRB side, I'll be disappointed if we don't get at least 50 billion over the next 6 to 8 months. So that will make a big change. So I think you have to look at it from all the combined policy action, which is the government and the Reserve Bank. I think this is very positive. See, the other thing was, it was a vicious cycle that the exporters were not bringing their dollars back. The importers were wanting to, pay immediately. So this was a vicious cycle because nobody had confidence in the rupee.
Yeah.
When you get measures like this, there is a confidence that, the RBI and the government are serious about doing something about the rupee. Then it stabilizes. And that itself is enough. Where if you take the gross trade for India, if you take the exports and the imports, over a year it's close to $1 trillion. So if you analyze it on a monthly, on a daily basis, that's a large number. And if everybody is doing exactly what RBI doesn't want them to do,
it was a run on the rupee.
So it's a run on rupee, exactly. So that is what stops. So you just need stability, and then you get these inflows. That is enough for the currency to, which is what I'm saying. The RER in 2013, you can argue was fair at that time because our current account deficit was almost 4.5%. There's no way you can justify an RER at 88 today, is the point I'm making.
Nice. Music to the ears. What does this also mean in terms of rate action, Sridhar? Because there was a lot of voices on the channel after the policy happened that, but wait for the second half and looking at the inflation projections. And I know you differ there, right? Totally. But looking at the inflation projections, could we see a rate hike? Are you in the camp which believes that there will be a rate hike? Or because the RBI now doesn't have to do a rate action to defend the currency, if you will.
Yeah. So I'm happy they didn't confuse the currency and the rate to start with, that they focused on this policy only on managing the currency and nothing on the rate. My view, and the data is available for everybody to see, RBI's credibility on inflation is very poor, to say the least. So let's go back to June of last year, same time, same projection they did for FY26. They said 3.7. And I had come on your channel after that, and I said that they are totally off the charts. I was getting closer to 2.5 at that point of time, and I bumped it up because RBI was at 3.7. So I said, okay, closer to 3, maybe 2.5, 2.75. Actually, we got 2. So RBI's projection was 3.7, we got 2. That's a massive difference for somebody who's projecting inflation. Now, you come back to the projection now, 5.9 for the third quarter. There's no way we are getting that number.
Despite everything.
So you have to keep in mind that we are talking of CPI. The weight of fuel and power combined is about 9%. Food is still closer to 40%. And I think one point which people are missing is that last year's 2%, about 60 to 70 basis points came from gold and silver. Now, gold and silver are going to positively contribute to inflation. So, not only because gold and silver were up almost 100 to 80%, it was a 70 basis points weight. So, that contributed to about 70 basis points
so
on the inflation.
So, instead of 5.9, do you think, where do you think it's going to be?
Around 4.5, 4.75.
Okay, so we are overestimating at this point.
Let's admit, projecting inflation is not very easy.
And right now, one would even give a little bit of a leeway to anyone trying to do that because things are so uncertain.
Yeah, but my only problem with RBI's projections is that they are always wrong on one side, which is they are always overestimating.
Yeah.
As a chartered accountant, we always used to say that whether you overestimate or underestimate, both are wrong from an accounting standpoint. It is very similar. If you're always overestimating, and you're wanting to be safer on one side, I mean, it somewhere tells me that something is not correct.
So then very quickly, 30 seconds, rate action in the second half on the upside or not really?
Possible, but maybe after September. Maybe 25 basis points. But as we stand today and I look at the data, you can even go without a rate hike because the currency is stable now. So the only argument for rate hike was you wanted to use it as a stabilizer for the currency that they've taken care of. And if this is transient, the above 4% is transient and it falls back to 4, then what is the need to do a rate hike?
No, but then one is assuming that crude will stay where it is, continue to trend lower, all of this gets resolved. That is one part.
Are we saying that the government is going to pass on all the crude hikes? Are they in a position? So I'm looking at data, I'm not looking at the sentiments and the side frills. The crude, the CPI calculation is based on the actual petrol diesel price. Not what
not
is
the crude
on the
basket or Indian basket or whatever.
The majority of the weight is for food, and
But
I
the
have
price
traveled.
hikes have been taken there.
Yes,
Milk has
but
gone
I have
up,
traveled
rice has
4
gone up.
states in the last 2 months, and I can tell you that pre-monsoon showers are very good. You're not seeing any impact. So the easiest thing for you to check is what is happening to onion potato price. Nothing else you have to see. They haven't gone up. They're actually down from last year.
Okay.
So
inflation is a bit of a boogeyman right now.
Yeah, and I think this El Nino is, I've heard this story many years. I will totally discount it. On the ground, I can't see anything.
We're looking for it in the sky. Yeah.
No, but
I've seen the skies, and I'm telling you, I mean, last year I told you the same thing. I can't see 5.9. I could be wrong, but I'm just saying based on the data, 5.9 looks very difficult.
I think Sridhar will say बादल तो होंगे लेकिन बूंदे तो बरसनी चाहिए.
बूंदे ऑलरेडी बरस रही है. बूंदे ऑलरेडी बरस रही है. मैं 4 स्टेट जाके आया हूँ. बूंदे हर जगह बरस रही हैं. जब 45 डिग्रीज में बूंदे नहीं बरसनी चाहिए, बूंदे बरस रही हैं.
इन 4 स्टेट्स में कंजम्पशन का क्या हाल है, मूड का क्या हाल है? Because that's also the fear, right? What is happening with the economy on ground, consumption, will Q4 and what we've seen in Q4 results actually?
So I think there are some challenges on consumption. So I will not say that there isn't any challenges on consumption, because as your fuel prices go up, there is apprehension that it can go up more. It is a sentiment. So there is some challenges, but it is not as grave as it was made out to be on inflation in the policy, is the point I'm making.
No, and from what Sridhar is saying with onion prices as well, but it's down. In fact, just last week, I was traveling towards Lonavala side. Their onion prices are actually at 10 rupees a kg. Have you ever seen onion prices at 10 rupees a kg?
I have no reference.
No, I have reference to this.
I need a backstory.
And it was a question mark to my mind as well.
Shopping for onions.
And when I saw that board that onion prices at 10 rupees a kg, it was really, I mean, I haven't seen 10 rupees per kg onions ever.
People buy chikki and fudge.
नहीं,
walnut fudge.
हमको देखना पड़ता है ना आजू बाजू. When we have Sridhar who's going to 4 states and tracking onion and potato prices.
Talk to us a bit about equity markets. We've talked about debt, inflation, macro. A lot of viewers seeing this will say, "Ye sab to theek hai, beautiful, but portfolios are looking terrible."
Okay, that is the other thing. What is the issue with the equity market? So let me give you data. Okay. Calendar year, we've had 10 straight years of positive returns. Okay, so this is calendar year as of December every year, which is a record by any standards. I have been investing since '93 in the markets. My first 10 years, 5 years were negative years. For 9 years, the markets did nothing. Now, when you take the CAGR of these 10 years, your average is around 12.5%. This is the large cap, which is the Nifty. Now, cut to look at the mid caps. Mid caps are almost at their all-time highs. Last 5 years, CAGR is 20% for a mid cap. So, if a mid cap fund manager would have given you a few percentage points more, if he hasn't, then there is a you can have a grudge. But if I'm giving it to a fund manager, assume that he is doing a good job. Now, the problem is that we are used to high returns every year. I mean, we can have a down year. I mean, what is the issue with the market?
It's a down 2 years. It's a down two and a
No,
half
it
years.
isn't. It isn't. That's what I'm telling you. 26, 25 also was a positive year. You can't have, if the 5-year CAGR is 20%, why should you complain? So my point is, yes, we've had challenging 12 months where earnings haven't been great. I think the problem is the relative returns, that when we are seeing US markets do what they're doing, Korean markets do what they're doing, that is a challenge that we have a FOMO, that ye miss ho gaya. But if I look at standalone the Indian markets, one, we have to accept that these are equity markets. You can't expect positive returns every year. So this may be the first negative year in 11 years. What is so bad about it? I mean, why are we complaining?
No, but I think, the complaint is also because everyone is looking at India as a collateral damage.
So yet
As
our mid
compared to
caps
your
are
other
giving you 20%
countries.
returns in the last 5 years. It's almost at its all-time high. What is your problem then? Where is the collateral damage?
Vis-a-vis, exactly, vis-a-vis
So
your...
yeah, I agree. Vis-a-vis Korea, Taiwan, we have an issue. But I'm just saying that if we keep comparing ourselves with other asset classes, we'll have issue. I'm not saying India doesn't have an issue. All I'm trying to say is that our expectation of returns have become so high that we are not even able to bear one negative year. So that is the point I'm making, that you don't get positive returns in equity markets every year. I started with 5 negative years out of 9, and the markets gave nothing for 9 years. So I think people have to get used to it. Despite all this, markets are giving you returns.
The question is why? Why do you have that negative sentiment? You're talking about it statistically, but that's not taking into consideration that we don't have an AI play, we don't have a large semiconductor company, we don't have a chip maker. The biggest weightage, or one of the biggest weightage in our Nifty, in our top 50 companies, or of a cohort of companies which no one knows whether they will make it to the next leg of technology change or not. It doesn't take into account all of that, Sridhar, to be fair.
It doesn't, and we've spoken about this for many years. 2 years back at your show, I said that we think IT is in a very difficult spot.
Yeah.
And it has played out that way. So we stayed away to a large extent from IT. As we speak, we have split opinions in our office, where some people think that
Everywhere
it is deep
there
value.
is a split opinion.
I'm still not in that camp. My point is, maybe the index may struggle because you have banks which are going through their own set of issues as we speak, the large banks, because the PSU banks are very aggressive. So 40% of the index is struggling with profitability because one cohort is growing very fast, but then they don't care about the profits. The other cohort is trying to protect its profits, so cannot grow. IT has its own set of challenges, but there are others. So you have manufacturing, which is doing well, defense is doing well, pharma, which is doing extremely well. You can pick and choose, which pockets of pharma you want. So if you are constructing a portfolio, there are pockets where you can make money. I'm not saying it is easy, but it is far better today than it was 18 months back, because the valuations were really stretched then. At least today, when we look at opportunities, you do find reasonable opportunities in the market. I'm not saying everything is in the large cap. Maybe the top 50, maybe the index may struggle for some more time, but below I'm saying the large cap index, but below the large cap index, there is definitely story, and it's showing up in the returns. I'm just saying, you don't have to ask me, you just look at the mid cap index, it's doing well. And if you see the top performers in the mid cap index, you'll see power equipment, you'll see manufacturing, you'll see pharma. So obviously there are stories, there are earnings, and we saw the earnings growth last quarter. So I'm trying to put based on data, I'm trying to put a picture, and I'm accepting that there are challenges for our markets. It is not like everything is perfect, but nothing is perfect always, right? So you find...
Sridhar, we have 30 seconds. Is it almost simple that make a portfolio which has got the exporters because they will benefit out of the currency tailwind that is behind them for the next, behind their sales for the next 12 months?
No, not as simple as that. There are consumption stories also.
Domestic consumption, which you think will
so you can find domestic consumption stories. Exporters, the largest exporter is in trouble.
Yeah.
So you have to leave the services export. Yeah. So beyond that, you can look at. But I'm just saying it is not just as simple. You will find stories even in banks. NBFCs are looking very interesting. Look at the way the housing, low-cost housing finance companies, their price-to-book multiples have collapsed from 5, 6 to literally 2 for ROAs of over 4%. They look very interesting. I mean, I was never a fan of that cohort at all. But now they look very interesting.
Is this the same setup that PSU banks were in 2020 or similar?
I would say similar. Adjusted for the ROAs. I mean, if you're getting 4% ROA, for this entire cohort and growing at 20%, then they do definitely look interesting. I mean, you can pick and choose the stock you want. There are 10 of them. There's one coming up for IPO right now. You can pick and choose. There is.
Okay, so a lot of ideas there. It's a positive view coming in from Sridhar. That's great to hear as we wrap up this edition of Editor's Cut. Thank you so much for coming in. And thank you to all of you for joining in. We'll be back here next week, same time, same place.
We're joined here by the Chief Economic Advisor, V.N. Nageshwaran. Thank you so much, sir, for taking time out. A bunch of new measures have been announced to incentivize more and more foreign investment to come in. Talk to us about what went behind it, what is the rationale, and what do you make of it now?
I think the rationale is to make sure that India is in alignment with the global practices, and investors ultimately do make their decisions based on what is on offer from all countries. And on that basis, we have brought ourselves on par with what is happening elsewhere, and therefore at the same time keeping in mind the overall macro external stability considerations in mind, because there is an overall ceiling as to how much we want to have foreign investments in the government securities. That has been kept in mind. At the same time, within that framework, we wanted to make it smoother and easier for foreign investors to access the Indian sovereign bond market, which is what the government has done.
Sir, you also say that at this point in time, there's no point estimates coming in from the FinMin, and we should go by what the RBI is estimating when it comes to GDP growth. So does that mean that at this point it's below 7%, the estimates?
No, obviously, it is you have seen multiple private sector estimates, multiple multilateral agencies, credit rating agencies downgrading not just India's growth estimate, but world growth estimates, developed country estimates, and Asia in particular is an energy importer, and energy prices have gone up by 40-50% depending on the benchmark that you are looking at. So it is natural that it will have an impact on growth outcomes this year compared to the previous years.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversation.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Medicine cannot function without a good pathology backup. People would bring the blood samples, say from All India Institute, from Ram Manohar Lohia Hospital.
उनका खुद का in-house नहीं था?
No, सबके पास थे. But what the expertise which we had, they did not have.
Started in 1949. The journey has actually mirrored the journey of modern day India.
My father, who started his career in the army, and in the army he specialized in pathology. He opened the first North Indian lab in 1949, and in 77 when he died, I was a lecturer in pathology in AFMC, so I came back and took over.
Were you always planning to do this, destined to do this, or were there other dreams along the way?
I never wanted to become a doctor. I wanted to join the Indian Navy.
Was there any point at which you felt that maybe, you had any doubts? Can you grow the business?
Every year or 2 years, I used to say that, Mom, I have to buy this instrument. And then she came down very heavily on me one day and she said, look, your father created such a big kind of a thing. And he never spent this kind of money in buying instruments which you are. So कहीं ये तो नहीं कि ये सारी तू हमारी practice बिकवा देगा.
I have a very special guest on the Disruptors today. I would say the OG of the diagnostic space, Dr. Arvind Lal, is with us in studio. It's an absolute pleasure, sir. Thank you so much for coming in.
My pleasure to be here. Thanks for getting me here.
Do you think the way I described the disruptive factor of your business is correct? How would you describe it?
Medicine has moved on. And modern medicine cannot function without a good pathology backup because, you know, what you have, the physician will not know. Let's take the case of jaundice. Now, everybody can see the yellowness in the eyes, but how much is the bilirubin, etc., how bad is the liver, the SGPT, SGOT, etc., can only be told from a blood test. And sometimes, you know, on the basis of a blood test, a person with very high blood sugars, 1,300 or so, etc., we've had to send that person straight away to the hospital. So blood test can be life-saving in certain situations, but it is good to get a blood test done at least once in life.
No, but I'm talking from the point of view of your company's journey. The company started in 1949. The journey has actually mirrored the journey of modern-day India.
Sure.
And at a time when there was no big organized laboratory chain like there is now. Now there are so many diagnostic chains. That was not the case back then.
Yeah, so it had just come into India, and Indians, you know, were discovering that they were good in medicine. Indian doctors always were very, very good. They were sought after during British times also. So my father was one such doctor who started his career in the army. And in the army, he specialized in pathology in Pune, which is, you know, Armed Forces Medical College. So AFMC was there for post-graduation even those days. So he specialized in pathology and came back. And so to say, he opened the first North Indian lab in 1949. That was also the year I was born in. And well, he specialized, went for further specialization to America in 1953, came back in 56, took the pathology services even further. And in 77, when he died, I was a lecturer in pathology in AFMC. So I came back and took over.
Were you always planning to do this, destined to do this, or were there other dreams along the way?
Good question. I never wanted to become a doctor. So that was an afterthought in my case because I wanted to join the Indian Navy. And I was the best cadet NCC Navy in my school, which was modern school, Barak Hambarwood in Delhi. And when I was getting ready to join the NDA, I discovered that I had a minus number in my left eye. Now, the Navy those days, and even now I'm sure, they don't take guys with specs in the executive branch. In the non-executive branches, yes. In the engineering branch, they'll take. In the supply corps, they'll take some other architect, you know. But in the Indian Navy, because you need to have very good vision, especially at night, to see objects, to see other ships and whatever. So my dreams of joining the Navy actually came to a standstill suddenly when I was 15, when I was about to think about going to NDA. And then I did not know what to do. And I did not have biology in school. And during my days, there was no class 12. So we were all supposed to change into arts or science in class 9. So 9th, 10th, and 11th. And in 9th, 10th, and 11th, you were supposed to, like me, who took sciences. So we had a choice between doing biology or geometrical drawing or doing geography. So I chose geometrical drawing because the Navy bug was still in me.
So what is the world looking like for you in 1977? You're in your 20s, maybe late 20s. You're taking over a business which is just starting out, it's doing well. And then now you have to grow. Because what your business is today is a very different beast, right? You've actually had to build that business acumen. What was that early journey like?
So the early journey in pathology, like most of the branches in medicine, was, you know, rudimentary. And new tests were being discovered, new instruments were coming in, People were training either in India or abroad how to do it. But the clinical pathology side of pathology actually was slightly below par. In fact, Mumbai was much ahead of Delhi at that time. But well, thanks to me, I also had to do something, so I changed all that. And then we went far ahead than Mumbai. And sometime, I hope Bombay is now caught up with us. So pathology is the backbone of modern medicine because 70% of diagnostic things or decisions are made on the basis of lab tests.
Yeah, no, that's absolutely true. But, I'm just wondering what that expansion plan looked like to a 27 or 28-year-old, or at that point, was it just about stabilizing the business and understanding the business for you? How did you grow from there?
The business was, I just wanted to do a good, honest job. People come in the morning for a blood test, in the evening they must get a correct report. So that was the end all of my thinking. And then people started saying, I remember, an elderly Sikh gentleman who used to come all the way from Model Town, which is North Delhi, and we were in Central Delhi in Connaught Circus area. And he would say that, why don't you open up a lab in Model Town? So I listened to him. I said, yes, sir, of course, we can think about it. Then I realized that he was not asking me about a lab being opened there. He was saying that, mera blood test wahan kar do. You can take my blood there. So that is what got into my mind. And I, for the first time, I think, in a committed way, I thought of collection center. And I said, we don't have to test there. I have to train a phlebotomist who can, get blood out in the first go, because that was very important those days, even now, I'm sure. And so we opened up in Model Town a collection center and would bring the samples all the way to Hanuman Road, which is Connaught Place area, and send the reports back in the evening. So that's how we started, just because of practicality. And I also realized that in my profession, every patient did not have to meet me personally. So that also helped. And nobody has time, so they said, Dr. Lal, as long as somebody can take the blood out, as good as you can, we are okay.
Was there any point at which you felt that maybe, you had any doubts? Can you grow the business? Did you want to maybe merge with a larger company through your journey? I just want to understand. I'll tell you where I'm coming from. Anyone watching this right now, they may today be in a position, and it's not 1977, it's 2026. They may be in a position where they've taken over a family business and there is this hunger to grow. And then the challenge always is, how do you take things further? Did any of those thoughts cross your mind?
So in my case, it was very apparent that everybody who wanted to get a blood test done from me could not come all the way to Hanuman Road in Central Delhi.
Yeah, so this whole thing of collection centers.
So collection center was, and that is, we were lucky that in my profession, we can collect the blood, somewhere else. And this idea was coming to me every day. Because people would bring the blood samples, say from All India Institute, from, Ram Manohar Lohia Hospital.
Unka khud ka in-house nahi tha?
No, sabke paas the. But what the expertise which we had, they did not have.
Can you still stand out today as a diagnostics business when there are so many doing the same thing?
Well, yes and no. No, in the sense because people, have to be very, very fastidious about the quality of testing. So the person who's behind the machine, now most of the tests can be automated. At that time when I started from a test tube and pipetting by mouth, etc. I've seen all those days. But now, you can take the blood from, the vacutainer incidentally was also introduced by me.
Ye kya hota hai?
We don't use a syringe and needle to suck the blood out.
Yeah.
You put in a needle and it fills up itself. You probably don't even remember seeing that. The blood in the tube behind fills up by itself with vacuum, because it's, so those are vacuum evacuated tubes, which I brought to India. So many things like that, many tests and many instruments. So I had a large hand in, what modern pathology, is. So we started small.
You're being very humble about it, sir. That's why, we wanted you on the show, because you have had, I don't think people realize the journey that modern pathology in India has taken, and you've been at the front and center of it. Let's understand and share some of your experiences, anecdotes, incidents which could be very, something that people can watch, understand and learn from, because you've had such a vast experience in business. When you're trying to grow your business, any business it could be, in your case it's pathology labs, what are some of the things that you should keep in mind? What are some of the biggest challenges that you faced?
So I'll tell you the first challenge. First, the challenge was that, as you know, my father had passed away. He and I never worked for a single day together. I was a lecturer in FMC in Pune. So when I came back, so now the elder person in my family was my mother. And she used to come and to do the the technical job.
She was involved in the business as well?
She came after my father went away. She would accompany me every day just to give me company. And she would do the other chores and I was busy in testing. And so every time, every year or 2 years, I used to say that, Mom, I have to buy this instrument. And she used to listen. And then she came down very heavily on me one day and she said, look, your father created such a big kind of a thing. And he never spent this kind of money in buying instruments which you are. So कहीं ये तो नहीं कि ये सारी तू हमारी practice बिकवा देगा. From her point of view, that instrument to me was like a toy. And people can get, they don't think much about toys after, it's left them, they're interested in something else. So I said, no, Mom, these are, believe you me. And she believed me, but initially with skepticism.
You had to prove yourself.
Yeah. So
even to your own mom, you had to prove yourself.
So my mom, because it was, she was the one who was handling the finances. And she was the one who would, tell me that, don't you think, you're going very far? I'll give you an example. Now, the thyroid tests had just come in late 70s. And we were probably the first ones in India to do the thyroid test in a private lab. Otherwise, it used to be only All India Institute or Institute of Nuclear Medicine in Delhi and in Tata Memorial Hospital here. So once I started doing those tests, there were new requirements because at that time, this test required radioactive reagents, which is supplied only by BARC. Now thyroid test can be done by everybody. But those days, it was coming in a radiation medicine format. That's how it started. And for that, we had to be specially trained. And that special training also involved setting up a different kind of a, testing facility for that, which we had to. And that is how, and she came down very heavily on me and said, what the hell are you doing? And for you, it is just a blood test and, 1 or 2 blood tests. How much are you going to charge? I told her how much I'm going to. So this is not done. But then she saw that from a trickle, we were doing 1 thyroid test in a month, then 2 thyroid tests in a month. And now we do thousands of thyroid tests in one day.
Yeah. No, so when you started out, when you're describing this time, I find it fascinating. How large was the team where you were testing yourself?
3 main technicians. I was the 4th. And then helpers, people who clean up or put the glassware, because a lot of things have to be in very clean, just like a kitchen. A pathology lab is like a sophisticated kitchen, actually.
And today, how many people work in Dr. Lal Path across the country?
7,000 to 8,000.
Imagine that kind of growth that you have seen. Did you think you would make a success of the business when you took over to this extent?
No, Tamanna, I never thought about the size of the business. I only was interested in doing a good job. That let's go, do it, give each patient a good report, a thorough, accurate report, and then if chance, comes my way again, I can expand it. I can go to another town. And then it so happened that I was the first one, stepping out of Delhi. So we had to think of all the possible things, the transportation of the samples, the stability of the samples in Indian heat, 45 degrees in summers. So all those cold packs, etc., had to be, started by somebody, and I'm glad it was me.
लेकिन आज जैसे अगर मुझे choose करना है कि where should I get a blood test from? What should I look out for? Will I look out for the cheapest, closest, fastest?
No, you should.
It's all the same.
No, there is a government accreditation also available now, known as NABL. So National Accreditation Board for Laboratories, NABL. So you should at least get your blood tested by an NABL accredited laboratories because they have been inspected. They have been given that stamp of approval. Of course, the other things are, not connected to quality, but commercial. If I have a collection center there, what time do I open? How fast can I give the report? Am I doing that particular test which you wanted to get done? All those things come later.
Now everyone's accurate. Yeah. Most are timely.
Most of them.
Convenience is there. Yeah. Everyone's competitive. What should stand out for Dr. Lalpat today? How do you now take it to the next level?
We always keep on doing that. That's our USP, that we'll take it to the next level, irrespective of what everybody else is doing. So we were the first ones who, started the collection centers of carrying samples, setting up labs in smaller towns, setting up more labs in a huge town like Delhi or in Mumbai, etc. So all those things, they come with age and come with time. Now, pathology testing is the backbone of pathology, modern medicine. So it has to be there in accurately and in good numbers. There's no point in if I just had churn out 10 tests in a day when the patient requirement is 100. So all those things have to come together. And pathology labs have become very, very sophisticated. There are, computerized equipments, etc., which can be programmed, just like a spacecraft, etc. And you can put the sample in by hundreds and thousands of tubes. And after some time, if you've calibrated it well, you'll get accurate results. And that is how things are happening now.
Sometimes doctors say, and a lot of commentary is that these bundled tests, which pathology labs give, they are actually not useful for patients. Because your doctor will write 5 tests, you will go to a pathology lab, anyone,
right.
And they will say that ये तो आपको बहुत महंगा पड़ेगा, आप ये करो हमारा पैकेज ले लो और उसमें आप 60 टेस्ट कर लो. So are Indians doing more tests than they need, too many tests than they need, just because the equipment and the technology now exists?
See, the harsh reality of life is that India is still doing under-testing. It's the other, countries in the vicinity, slightly more developed than us, who actually, do a lot much more tests, which are obviously required. So once in a blue moon, you can get a whole panel of tests required and discover, there is something, which is wrong. I'll give you an example. A classmate of mine, a doctor, came to me and he said, "Yaar, mera ye test kar de." So we did the test, etc. And we found a CPK to be increased. A CPK actually gets increased when you're having a heart attack. It's done. But CPK can also be increased in certain other conditions like muscular, etc. So I discovered a muscular problem in his body which he never knew. So there are many times, you are doing a test, he came to you for something, disease A, but you found disease B. And vitamin D is now, something like that. And so many other tests. The lipid profile came in. Indians by nature are dying at a younger age group, say at least 10 years younger than their, Western counterparts. Because number one, we have a gene which, brings it down, the age down. And also because of a lifestyle. So these are also known as lifestyle diseases, and which can be improved. You improve your lifestyle and you'll become better. So our job is to increase the lifestyle because India is really suffering. And 2% of our GDP is dependent on lifestyle diseases not being controlled. So as doctors, we feel that the input of India, we also want to, chip in to the welfare of India, goodness of India, etc. So we want to make it aware. We want to tell everybody that please come, at least by the age of 20, 25, at least get 3-4 basic tests done. And the numbers are very high in India. So
okay. So by 25 years, what is the set of basic tests that every individual should do, man or woman?
For a woman especially, let ladies first. So hemoglobin is very important. So with hemoglobin, we have a short form known as CBC. And that CBC does 3-4 other tests also. I'm not going to go into that, including a WBC count, including a platelet count, something else. So that is a kind of a package of tests because it is all done in one go in one machine. You can tell that machine that I want only hemoglobin, but it's going to, use the same amount of blood and probably charge you the same amount. So hemoglobin, etc., is very important. Hemogram, we call it. CBC, we call it, complete blood count. And then there are 4 or 5 basic tests like blood sugar, cholesterol, SGPT for the liver, and creatinine for the kidney, and one odd test which I may be missing right now.
And it's the same for men.
For men also. Yeah.
How often should you get a full panel blood test?
So full plan, if it's okay that you can afford it at least once in a year.
Okay.
And then go after the tests which are out of range and which the doctor will discuss with you. You can take your own physician will tell you that yes, I have found that your cholesterol was high. High cholesterol brings heart attacks closer to you. So we should not do that. So he'll improve your lifestyle, make you eat less fats and allied things, maybe even give you a statin, because now things can be controlled. So that's the way we look at it.
Do you think Indians are also under-tested because people don't have the ability and the monetary capacity to test so much? Because this is one aspect, at least Indian insurance doesn't cover diagnostics. Now, insurance coverage has improved, but it does not cover diagnostics. Do you think that that's something that needs to be remedied?
So it's being penny wise and pound foolish, because it is not covered by insurance. These OPD kind of procedures, which we counted as OPD by the way, and so they said that we are not going to reimburse you. Whereas our timely detection, a guy who's got high urea or creatinine or a high blood sugar or high cholesterol, well, if we tell him at that point of time, you are saving not only thousands and lakhs of rupees for that person, but you are saving a bread earner. In India, as I told you, that things are happening 10 to 15 years earlier than in Western counterparts.
Why do you think that's happening? We hear so much about young people in their 40s and 50s dying of heart attacks. Why do you think that's happening?
Number one, genetics, because we are Indian. Number two...
But we were always Indian. We're hearing about it more now.
Yeah, because people were dying, but they did not know why they were dying. So, Rab ko pyara ho gaya and all that, we used to hear. But now we can actually increase their lifespan by testing them earlier. So all what I'm trying to say is that there are 4 or 5 tests which should be done as soon as a person is 20 or 25 years old. One is blood sugar, one is cholesterol, one is creatinine for the kidney.
Whether you have any symptoms, disease, concern or all.
Because this will find out. This will find out if you have something. If you don't have it, you are clear. At least for 1 year, maybe even 2 years in a younger age group. But in the elderly age group, these things should be done every year.
Do you think that there is a need or something that you envision now as a next step, since this is what you've talked about?
Yeah.
Every Indian should have access. How do you take access beyond the large cities?
So the first is that, it's all relative, to India, that our costs are actually the cheapest in the world. And our costs are somehow, sounding higher for the patient, because the patients were never subjected to this kind of sophisticated testing. Third thing is that most of these reagents, now many reagents are being made in India, they used to be imported, especially from the time I'm talking about. And the government of India, not to be missed out, wanted its pound of flesh. So there was, God knows, 140% duty at that time. I forget the exact amount now. And that they still haven't given up. I think the duty is now in the region of about 30%.
This is on testing equipment?
On testing reagents.
Okay.
Equipment also, reagents also. So then, as happens in India and many things you must have heard, so there is a life-saving test. So life-saving test was classified under 3-4 categories. Thyroid was one of them. And then the duty was 0. So we have come a long way. We are improving every time. Things have been brought to the notice of the government. The fora in which I am, this is my job to keep telling the government that do this, and they listen.
Dr. Lal, you have been doing this for so long. You are still actively involved in your company. I'm sure you need not be if you don't want to. What really keeps you going?
I am in kind of old school of thinking that man must, do some work which is productive work. After all, I may be 76 now, but I'm still walking around. I go for morning walks. I can still work 8 to 10 hours a day, etc. So when I don't feel like working, I will not go.
So no concept of retirement.
So the retirement in private practice, there are old doctors who are practicing till their 80s, etc. And so I don't know. But if something, is going to happen to me, or I find something better than this to do, I have no idea. I may, think of changing band, or keeps changing every time.
Yeah, so always look for something new. It's been inspirational speaking to you, sir. Thank you so much for coming in today.
Thank you very much, Tamanna. Honor being here.
Thank you, sir.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
We'll be traveling back to Delhi first thing tomorrow morning, where we'll be meeting with Minister Goyal, and we're very optimistic. Look, we're 99% there. The last 1% we're working on.
So SBI AMC, is there a timeline yet for the IPO?
We hope to do sometime during this year. We are just waiting for the regulatory approvals.
In the near future, it looks sustainable, but it all depends on the environment and the war. So if it really deteriorates and one doesn't have any idea of when will it end, every day you get hopes and the next day the hopes are dashed.
There is a cost impact, and I would say there's a 100 crore cost impact, but I think that we've repriced some of our services to build in the inflation that's come from that.
But if you could give us some details about what that 1% is.
That's a great question. You must be with the media. Are you? What outlet?
NDTV Profit.
Great question.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you.
Hello and welcome to the special show that you're watching on NDTV Profit. India is making a strong pitch for global debt flows to come into India. By scrapping the taxes on foreign investors, government bond investments, the centre is really aiming to make Indian G-Secs more competitive, attractive as well as liquid in global portfolios. Meanwhile, the government has also opened the doors wider for the foreign investors, easing the investment limits and expanding the access routes. The move is designed to really improve the market depth, encourage the long-term flows and broaden the participation in India's bond market. To discuss more, we have a whole host of investors as well as experts really joining us on the show. But let's first hear out the RBI governor on this particular decision on slashing the FPI tax on bonds. Let's listen in.
We are expanding the universe of specified securities by including all new issuances of 15, 30, and 40-year tenor G-Secs. Till now, only securities, government securities up to 10-year tenor were included. In addition, limits pertaining to short-term investment, concentration, and individual securities on FPI investment under the general route are being removed. The government recently, this morning, has provided tax benefits to government securities. All these measures together should help attract foreign capital for government borrowing.
All right, so it's a big reform coming in the taxation on the bond market. Government is rolling out this big reform push to really deepen the Indian bond market, making it much more robust and with larger participation, especially from the dollar economy, making sovereign debt far more attractive for the foreign investors. And this sweeping set of tax changes, FIIs, will now enjoy zero tax on both the interest as well as the capital gains from G-Secs. Let's take it across to my colleague Shrimi, who has been really focusing on this particular development very, very closely, tracking it there, and breaks down what this means for the flows and yields in the rupee movement going forward. Shrimi, tell us.
Well, absolutely. The government has announced a sweeping set of reforms aiming at making India a more attractive destination for global capital, with the biggest takeaways being a complete tax exemption for foreign investors on income and gains from the government securities. Effective from April 1st, 2026, foreign portfolio investors will no longer paying the 12.5% long-term capital gains tax on the government securities. The government has also scrapped the 20% withholding tax on interest income from these bonds. Now, in effect, returns from eligible Indian government securities will become absolutely tax-free for foreign investors. So that's one. Further, the government has also, under FEMA rules, eased investment rules for persons residents outside India, which is PROIs, to invest in equities via the portfolio investment scheme. Now, while the investment limit for an individual PROIs in a listed companies has been increased to 10% from existing 5%. The combined limit for all individual PROIs has been raised sharply to 24% from existing 10%. On the debt market side also, the government has widened fully accessible routes, by including 15-year, 30-year, 40-year government securities, as well as sovereign green bonds. It has also removed several restrictions that foreign investor had long sought to be eased, including the short-term investment limits, the concentration limits, and the security-wise caps in the government securities. While these restrictions have been lifted, the overall FPI's investment cap, and that's very important, remain unchanged at 6% for central government securities and 2% for state government securities. The government has also merged the existing general and long-term investment categories for FPIs in government securities, simplifying, of course, the overall framework. So taken together, the measures mark one of the most significant liberalization steps for foreign investors in recent years, and that's what Finance Ministry highlighting, signaling the government intent to deepen, India's bond market, improving ease of sentiments, and of course strengthening the India's position in the global capital markets. But we need to see the revenue impact as well. So we are waiting for more information, and let's see how this will unfold.
All right, Shrimi, thanks so much for breaking it down for us. It's a big reform push for foreign investors to really be keen and attracted towards Indian bond market. Neeraj Gambhir, the Executive Director, Axis Bank, Dinesh Kanabar, CEO of Dhruva Advisors, Deven Choksi, MD at Dr. Choksi FinServ, join in now. Thank you so much, gentlemen, for joining in. Deven Choksi, my first question, before getting into the nitty-gritties of what this particular reform push really means, how much of a halo effect will this particular reform and lowering of taxation really have on the FII inflows on the equity market, and what is required there?
Yeah, good afternoon, Nisha. Well, I believe that I think the direct impact is not likely to be felt, but I think somewhere indirect impact will have to be analyzed. Assuming that RBI is not intervening while the inflow of dollar is taking place under these particular assumptions of $30 to $40 billion inflow of money, which could possibly come due to this particular taxation changes. Assuming that I think that money is entering into the system. So every $10 billion has a potential to basically give the rupee appreciation of between 25 bips to 40 bips. Now, assume that I think it is $40 billion worth of inflow. Theoretically, I think we are talking about somewhere around close to 1.4, 1.5% kind of an appreciation, or 1.4, 1.5% appreciation, I think, which is basically theoretically possible, should RBI not intervene into this. Now, if that is a situation which is envisaged, and that is dependent on RBI's policy, of course, then that answer to your question would be that yes, some of the foreign investors who have been taking the money out, I think almost 2.5 lakh crore worth of money has been moved out. I think they may probably stop that particular route, and that is where I think you may see the stability come returning back of capital happens in the equity market. So yes, I think there is no direct answer to it, but I think it is subjective answer to what RBI takes hereafter. But the potential remains high as far as I think the foreign investors are concerned to bring the equity money back into the country.
Right, Deven, very well put. It will have some impact when it comes to the minds of the foreign investors in terms of India as an attractive destination, but whether it will solve the problem of FII outflows in the equity space, that needs to be seen. And Dinesh Kanabar, what does this really reform mean for the foreign investors when we position India and India's bonds?
So to my knowledge, Anisha, there have been multiple representations, at least over the last 3 years, which were made to the government, to the Ministry of Finance, to say that there is a deep interest that exists, whether it is sovereign wealth funds, whether it is FPIs, who would like to invest in long-term government bonds. That market exists. It's a fairly robust market. And the question was that the taxation of the interest at 20%, the capital gains, of course, are de minimis. It's really the interest which one is looking at here. The question was whether that 20% withholding tax in India is something which would deter the people from investing. So let me give you a concrete example. Let's assume that the rate of tax on GSEC is 6%. And if you have a 20% tax, then you are effectively looking at 4.8%. Now, when you look at that, most of these investors are not taxed in their home country. Therefore, they have no ability to take a credit for this in the home country. So this amount becomes a dead loss. Now, many of these come from tax treaty jurisdiction, where the rate of tax does go down from 20% to say 10% or 15%. But that, as you know, is a big challenge. How will you monitor? How will the custodian of the security monitor the eligibility to treaty? Tax residence certificate. So again, we are getting into a number of things. And therefore, a representation was made originally to say that either you make the tax nil, or even if you don't, provide a fixed rate of tax so one is not subjected to vagaries of the tax treaty, etc. And I'm really glad that the government has heard these recommendations. We have a nil tax. What that effectively means is that whatever is the rate of interest paid by the government is the effective income of the investors. As the RBI governor rightly mentioned, we are increasing the tenure. Therefore, the money which is coming in is long-term money, stable money, which India would like to have, and therefore becomes fairly attractive. Again, because of nil taxation, there are no compliance issues, no need to file tax returns, no treaties, no nothing. Very, very welcome move.
Right, Dinesh, many aspects that you touched upon, and yes, a lot to discuss on that. But Neeraj Gambhir, what does this really mean for rupee in particular, and therefore the overall economic impact in terms of our forex reserves? And also the momentum has been seen from all the quarters of the government in making the debt market very robust in these trying times. Would you agree?
No, certainly. I mean, I think for the last, almost 2 years, we've been seeing very weak or negative equity flows, in the market. We've also seen net FDI turning steadily lower and lower and now close to zero. So equity flows have been weak. So it's the time for us to actually go for debt flows. Globally, fixed income markets are doing very well. Credit spreads are at their tightest levels. There is a lot of liquidity in the market. You've seen how much money big corporations in US are able to raise for their for their AI investments. So these are clearly very, very welcome moves. As Mr. Kanabar explained, that the total amount of impact in terms of earning for the foreign investor goes up by roughly 50-60 basis points to almost 120 basis points. So the spread that now government bonds offer over, let's say, US treasuries, because there is no tax impact, almost becomes like 150 basis points. So, 250 basis points. So I feel that this is a good incentive for the investors to start investing in domestic market. India is one of those few markets where you have long-term bonds, where you have bonds going all the way up to 40 years. Not many economies of the size of India offer that kind of duration, which is very, very attractive to insurance companies. So I feel that you will see some real long-term flows coming in as a result of this. I would also like to add that it's not just these set of moves that you have described which will have the impact on the market. There is parallelly, Reserve Bank has announced a whole bunch of measures with regard to the hedging cost for ECBs as well as hedging cost for the FCNRB deposits. I think those will have a much bigger impact on the capital flows into the country, particularly the debt flows into the country. And with these kind of flows coming in over the next 4 months, I do expect the rupee to start sort of, it'll have a lot of calming effect on the currency market. I do expect rupee to start having less volatility and maybe less need of intervention by Reserve Bank at the moment to make sure that it doesn't depreciate too much. And once the flows actually start coming in, it's possible that rupee may actually appreciate. Right. Of course, it depends upon what happens to the war and what happens to the crude oil prices.
That's right. Neeraj, you touched upon a very important point on the rupee stabilization and probably certain appreciation as well. Devin, it has been a chicken and egg kind of a story where FII outflows means rupee depreciating further, and rupee depreciating further also gives a very, jittery economic picture about India to the foreign investors. How much do you think rupee stabilizing and also appreciating will really impact the equity market momentum and therefore the foreign investor view on overall India foreign investments?
So here I think the two parts of foreign investment. One, of course, I think the underlying equity market in which they invest. And the second part is derivative market through which they are operating. A significantly large amount of volume is happening on the later side than in the underlying equity side. If underlying equity is the one where probably I think they're reducing their holding because they want to shift the portfolio out to some other parts of the world, given the kind of newer preferences of industries that they find in Taiwan, South Korea, or even for that matter Japan, in which I think they basically want to invest into new age universities, including semiconductors, AI at the same time, and the data centers. That's the reason for which underlying equity is being swapped into those markets. But more importantly, I think what could possibly or what is going unnoticed in the marketplace today is a significantly large amount of operations carried out into the derivative market, which is the resultant cause of, I think, taking out the capital out of the markets. I think that's where probably I think we are required to take little more precautions. Maybe I think the plot is lost at this point of time, but I think some more precautions are required to be taken. Should that happen, my understanding is that Indian market would start attracting flows back because underlying growth assumption in the business, I think, remains absolutely intact. Valuations, at least in the frontline stocks, they remain quite comfortable today. And maybe if the kind of 15% growth that we are assuming in a normal situation, maybe I think we would be seeing the flow returning back into the market. That's what my take would be.
Right. So, Devin, very important because this is a big reform and it sends out a message to the investor community overseas as well. The dollar community which we are trying to attract. Dinesh Kanabar, does it address the biggest pain point of uncertainty on taxation and also ease on even the interest income? All that is giving ease as well as higher returns, which is really addressing the two pain points that the investors have, especially in the debt market in India.
Very well said, Anisha. I think more than the tax, it's really the compliance burden and the uncertainty which creates a lot of complication. So, for example, assuming you were investing from a country with which India had a tax treaty and your rate of tax had come down from 20 to 10% or whatever be in that particular treaty, to get that treaty eligibility is a big pain. Will it be at a withholding stage? Is tax residence certificate sufficient? How will you prove your eligibility? Will you pay tax and withholding and then claim a refund? All of those becomes very, very big challenge. The very fact that you have to file a tax return in India, where you have nothing, no income other than interest income on government security, becomes a point where investors become very cagey as to whether or not they should invest. So apart from the fact that the yield itself has improved significantly, the fact that there is zero compliance burden, because now I don't need to really file a tax return at all. There is no such thing. I don't need to meet a custodian. I don't need a chartered accountant in India. I need nobody to give me advice. I'm simply sanguine that the interest which I have got is my income, nothing further to be done. And I do wish that even as we look at many of the other things on equity, it's a different subject, of course, altogether, that we are able to provide better certainty and ease of compliance to investors as we are doing for government securities.
Right. So even, using DTAA, the taxation treaties, as well as also routing through safe havens, all that cumbersome structuring, all that can be done away with this clarity coming in. Very well put, Dinesh Kanabar. Deven Choksi, what is required for the equity side to really become as robust and to also attract investors on that side? How grave is the situation and what would be your suggestions at this point?
Well, I think the majority of it is basically being spelled out. When you look at Indian equity market and the taxation, Dinesh Bhai just alluded to this particular point. And in the debt market, I think equity side, you are charging, significantly different taxes. I think the STTs, the LTCG, the STCG. And as a result of which, I think it indeed increases higher amount of burden. Whereas I think those horizons like Singapore or UAE for that matter, I think over there, I think these kind of taxes are not levied. In fact, I think STT is only unique to India. So from that particular perspective, yes, I think we are not giving a right signal to the outside world, for sure. We definitely have compulsion to collect money because of, running the economy. But at the same time, I think the hardship which it causes to the investors is actually putting them off. And that is where I think they're swing very quickly this money out of the country and put somewhere else where they see the better opportunities. In my viewpoint, I think these procedural issues, if they can be addressed, the rest of the fundamentals are definitely remaining in place. Today, Nifty 50 at a valuation at which it is quoting, probably historically, I think it has found buyers at such valuations. And I am not having doubt in my mind that this valuation, I think it attracts fairly well, provided some of the hassles go away. And I think the opportunity once again resurface for investors to come back.
Right, more opportunity for investors to come back to India, and of course, hopefully, rupee stability will impact. Neeraj Gambhir, very quickly, the other measures which are also going to impact the rupee movement, and what's the in-house call after this particular announcement on the rupee appreciation and the levels that you're looking at? Very quickly.
We don't have a house call on rupee appreciation because I think this is a short-term measure. It will have a short-term impact.
Right.
And then over a period of time, we will default back to the structural issue that we have, which is basically we have a current account deficit, which is going to become bigger because of crude oil prices. And we don't have, long-term flows like FDI at this point in time, net FDI flows. So we don't have an appreciation call. I think we could see some short-term appreciation, but once the flows are done with, then we could sort of move back to a depreciating territory. But hopefully this time around with lesser impact and much more milder depreciation than what we've seen in the past. Typically, rupee depreciates about 3 to 4% in a year, right? But that's adjusting for the inflation differential that we have between us and, let's say, US. Right now, the inflation differential is going to open up again. So maybe the pressure for depreciation will be there, but maybe not as much.
Neeraj, stay on. Piyush, my colleague who was right there at the RBI's press conference today, is joining in. Piyush, what are the specific sharp details on how rupee can really be impacted with today's announcements?
Nisha, the whole idea behind the measures that the RBI has launched is to attract dollar inflows and of course help rupee. The RBI has proposed that it will allow FPIs to now invest in 15-year, 30-year and 40-year GSECs, as against earlier they were only allowed to invest in 10-year GSECs. They have also eased the investment limit, the concentration limits, so that more FPIs can bring in money, and also they have introduced FCNRB deposits. They have said that they will bear the hedging cost for banks if they raise fresh FCNRB deposit. This move was done I think 11 or 13 years back last time. So these are very big major moves. In terms of inflows, yes, the governor did mention that they expect significant amount of dollars and foreign currencies to pour in. However, he said there is no particular target, and this facility, essentially, all these measures by both government and RBI are aimed towards, bringing in FII and FPI inflows.
All right, Piyush, thank you so much for joining us straight from the Reserve Bank of India headquarters. Neeraj Gambhir, Dinesh Kanabar, Devin Choksi, thank you so much for your expert take on this big set of announcement that has really come in, and more needs to be seen on what happens to attract the equity fund flows as well. That's on our radar, but definitely government has been looking at drawing in the moolah and attracting the dollars. Thank you so much for tuning in.
India's unshakable news habit. NDTV.com is India's #1 English news website.
Hi, I'm Tamanna Inamdar. Watch me on NDTV Profit, where I break down the day's biggest business stories. What happened, why it matters, and what it means for your money.
Hi, I'm Neeraj Shah. Watch me on NDTV Profit for the most incisive market intelligence and meaningful corporate conversations.
And I'm Alex Matthew. Markets, mutual funds, insurance, personal finance. I help you cut through the noise and make smarter financial choices. And here's where you can watch us.
Be traveling back to Delhi first thing tomorrow morning, where we'll be meeting with Minister Goyal, and we're very optimistic. Look, we're 99% there. The last 1% we're working on.
So SBI AMC, is there a timeline yet for the IPO?
We hope to do sometime during this year. We are just waiting for the regulatory approvals.
In the near future, it looks sustainable, but it all depends on the environment and the war. So if it really deteriorates and one doesn't have any idea of when will it end, every day you get hopes and the next day the hopes are dashed.
There is a cost impact, and I would say there's a 100 crore cost impact, but I think that we've repriced some of our services to build in the inflation that's come from that.
But if you could give us some details about what that 1% is.
That's a great question. You must be with the media. How are you? What outlet?
NDTV Profit.
Great question.
He has been tracking markets for over a decade, spots the trends before they hit the screen. And he is now bringing his analysis to the show that the market watches. Watch Sharad Dubey on Know Your Company, a show that puts the most traded stocks under the scanner. We dissect the company so that you, the investor, don't have to get the management to answer questions relevant to you. Watch Know Your Company weekdays at 11:30 a.m. to understand your next big bet. India Inc.'s most respected names chose India Inc.'s best and brightest.
I'm delighted to be sharing with you of such distinguished fellow businessmen, bankers. It's just lovely to be back on this NDTV jury. I have been a fan of NDTV for a long time.
Many of the nominees are extremely close together in terms of what they've done.
Gender parity to be reflected while we choose leadership as well.
It's also important that how they are reshaping the industries.
We got a fantastic jury and we've left all decisions to the wisdom of the jury.
Who will earn India's top business honors? Find out on 3rd July at the NDTV Profit Business Leadership Awards. When the headlines move fast, perspective matters. On Editor's Cut, our editors come together with experts to distill the week's information blitz into clear perspective. Down the stories shaping the world, from markets and the economy to global conflicts and what lies ahead. This is where experience meets insight. No noise, no hype, just sharp takes on what to watch next. Editor's Cut, every Friday, 3:30 p.m. only on NDTV Profit.
The news, Ayush. Since when do we do scripts? Fair point. Picture this. The biggest stage. Floodlights. Wow. 4K, the works. Where's the hook? There's going to be celebrities and guaranteed eyeballs. Where's the hook? Think about this. Front page advertisements and hoardings. Bro, where's the hook? Cross-platform, digital first, virality. Without a hook, no way. The message is clear. It's 2026. You've got to be real in a world of reels. You've got to be original in a world where everything seems generated. That's it. That's what we're looking for. The best campaigns, the hottest trends, the smartest brand moves on our new show. But wait.
Good evening. Welcome to The Bottom Line. I'm Vikram Oza. Now, headlines normally tell you what happened, but this show is very focused on why it matters. Here are the news stories that we're tracking on the show this evening. First up, India's GDP numbers beating estimates. FY 2026 growth is pegged at 7.7%. The chief economic advisor saying that nominal GDP growth for FY27 could be significantly higher than the one that is estimated of 10.1%. The government scraps capital gains tax to woo foreign funds. FIIs are going to enjoy zero tax on interest and capital gains for FPIs in government securities. It's a big boost to inflows. The CEA says that measures will help narrow the current account deficit going ahead from here. In the currency markets, the rupee has made a sharp comeback, erasing all its losses for the week after the RBI unveiled fresh measures to attract foreign capital. The rupee sees its best performance in 2 months. The RBI keeps the repo rate unchanged at 5.25% amidst the oil price shock. The RBI opting for caution as the inflation outlook rises. In the equity markets, we've ended above 23,000, slightly changed after a volatile session as investors digest a slew of measures by the government as well as the RBI governor's remark on policy. The Nifty and Sensex have both shed 0.7 of a percentage point each for the week. Prime Minister Modi says that while fuel prices swing globally and gas supplies strain, the government has kept oil flows steady, boosting solar push and also ensuring energy security, staying intact despite all the turbulence. The price of crude oil has eased slightly amidst uncertainty, prices steady since yesterday. Trump now signaling optimism on ending the conflict with Iran. Brent holds around $94 a barrel. In the automotive sector, VinFast-backed Green SM has entered India with its all-electric taxi services. They've launched in Delhi NCR and they're betting big on EV mobility as the ride-hailing battle heats up in key urban markets that have been established by the likes of Ola and Uber. Up front, here is the top line, the big news that we are tracking this evening. India's growth story has ended FY26 on a stronger than expected note, importantly with momentum intact. And the economy has clocked 7.8% growth in the March quarter, beating market expectations, taking full year FY26 growth to 7.7%, which is higher than what economists had penciled in. So this is not just a statistical beat. It is a signal because this growth has come despite a difficult global backdrop from geopolitical tensions, elevated oil prices, weaker external demand and trade disruptions. My colleague Shrimi is joining us for a deeper dive into the numbers. Shrimi, how's it looking?
Well, India's economy grew 7.8% in the January-March quarter of FY26, slightly lower than revised 8% growth recorded in the previous quarter. But of course, the stronger than expected fourth quarter performance, which has, pushed full year growth to 7.7%, beating its estimate of 7.6%. While the FY26 number reaffirmed that India position as one of the fastest growing world economies, and in fact, CEA Anant Nageshwaran indicated that FY27 could be more challenging year, of course, due to rising uncertainties. CEA said that Finance Ministry would not provide a separate FY27 growth forecast and would instead, refer to RBI projection, which is, now 6 and below actually the 10%. He also noted that nominal GDP growth could be significantly higher than the budget estimate of 10.1%. A key concern, however, according to Nageshwaran, is that evolving West Asia crisis, which could perhaps pose both a significant supply shock and a potential demand shock to the global economy. Even so, high-frequency indicators such as domestic demand and economic activity in India have remained fairly resilient so far, and that's very important take from the CEA. And on the external front, India's merchandise and overall trade deficit widened in FY26. That's also concerning, as CEA said a similar trend could continue in FY27, potentially putting pressure on the current account deficit. However, this tax relief which we have seen by the government on FPIs will definitely improve the situation, he underlined. Government also flagged emerging inflation risk from supply side pressure. However, Nageshwaran remained confident on the fact that India's policy framework and ongoing reforms would help cushion the impact of global shocks if growth falls below 7% because of external development. In fact, government policies will help bring it back to around 7% is what the anticipation from the CA is coming. So overall, of course, it's a strong number, but we need to wait and watch for FY27, how that will pan out.
Certainly, that remains to be seen, Shrimi. Thanks very much. But the bottom line coming through is this, that India is still the fastest growing major economy. It's outperforming expectations, but the real challenge now is not growth momentum. It is how durable and how inclusive that growth can be in what is clearly a more uncertain world. And that's exactly what we put to the chief economic advisor, from growth resilience to capital flows and policy choices as well. This is what we got from V. Anantha Nageshwaran in this exclusive conversation.
At this point in time, there's no point estimates coming in from the FinMin, and we should go by what the RBI is estimating when it comes to GDP growth. So does that mean that at this point it's below 7%, the estimates?
No, obviously, it is. You have seen multiple private sector estimates, multiple multilateral agencies, credit rating agencies downgrading not just India's growth estimate, but world growth estimates, developed country estimates, and Asia in particular is an energy importer, and energy prices have gone up by 40-50% depending on the benchmark that you are looking at. So it is natural that it will have an impact on growth outcomes this year compared to the previous years.
And that strong growth print that we are talking about is also explaining the policy shift that we are seeing. Because if India currently now wants to sustain this momentum, it needs steady and long-term capital, not just flows that come and go with global volatility. Which is why the government is now moving to make India's bond market that much more attractive to global investors. For years, foreign investors, they have drawn to Indian government bonds for their relatively higher yields and stronger growth outlook, but taxation on interest income and capital gains has been a key friction point. That friction is now being removed. Now, the government has exempted foreign institutional investors from tax on interest and capital gains from government securities. It is a clear push to deepen the market and to widen participation as well. So the idea is simple. You bring in more stable, more long-term global capital, especially at a time when external conditions remain uncertain, and then capital flows can turn volatile very quickly. So the bottom line on this is that India is not just growing faster than expected, it is now aligning its policy framework to sustain that growth, making the debt market that much more competitive and investor-friendly in the process. Let's bring in what the RBI Governor, Sanjay Malhotra, had to say about this.
We are expanding the universe of specified securities by including all new issuances of 15, 30, and 40-year tenor G-Secs. Till now, only government securities up to 10-year tenor were included. In addition, limits pertaining to short-term investment, concentration, and individual securities on FPI investment under the general route are being removed. The government recently, this morning, has provided tax benefits to government securities. All these measures together should help attract foreign capital for government borrowing.
In fact, on this subject, not just the RBI governor, we also had a word come in on the new FPI norms in that exclusive conversation that we had with the chief economic advisor. This is what he had to say about it.
A bunch of new measures have been announced to incentivize more and more foreign investment to come in. Talk to us about what went behind it, what is the rationale, and what do you make of it now?
I think the rationale is to make sure that India is in alignment with the global practices, and investors ultimately do make their decisions based on what is on offer from all countries. And on that basis, we have brought ourselves on par with what is happening elsewhere. And therefore, at the same time, keeping in mind the overall macro external stability considerations in mind, because there is an overall ceiling as to how much we want to have foreign investments in the government securities. That has been kept in mind. At the same time, within that framework, we wanted to make it smoother and easier for foreign investors to access the Indian sovereign bond market, which is what the government has done.
So those new norms really opening up something that could be that much more long-term in terms of keeping the foreign inflows going. Meanwhile, the rupee has staged that sharp comeback. It's erased all its losses for the week, and this has happened after the RBI unveiled those fresh measures to attract foreign capital. The currency has strengthened nearly about 0.8% this week, if you see its trajectory, and has slipped below that 95 to the dollar mark for the first time since Monday. While the easing of pressure from the Middle East conflict and the RBI support, both of these have boosted sentiment, the bigger picture on the Indian currency remains the challenging one. It's still down around 6% against the dollar so far in 2026 alone. It remains nearly 5% weaker compared to levels that we've seen before the Middle East war erupted. The markets are now going to watch whether foreign inflows can sustain this kind of recovery on the Indian rupee. Meanwhile, amidst continued volatility in global energy markets and the elevated crude oil prices, the Prime Minister has spoken, acknowledging that the pressure from the fluctuating fuel costs and saying that India is facing the challenge strongly. His remarks come at a time when the government is looking at shielding the economy from global energy shocks while maintaining supply stability, something that he spoke about. Listen in.
इतना बड़ा ऊर्जा संकट इसने पूरी दुनिया को अस्त व्यस्त कर दिया है। दुनिया भर में पेट्रोल की कीमतों में लगातार उतार चढ़ाव हो रहा है। गैस की सप्लाई चेन ध्वस्त हो रही है। लेकिन भाइयों बहनों, मुझे बहुत संतोष है कि 140 करोड़ भारतीयों के साझा प्रयासों से देश ऐसे हर संकट का मजबूती से मुकाबला कर रहा है।